And all of that very much in focus as we wait for those Fed minutes. We'll get those later on today. The Brent price also in focus as we talked about at the end of the last hour with Mark. Despite geopolitical concerns, we saw substantial weakness in oil prices yesterday on that broader risk aversion. This then is the futures picture for Europe. Flat to negative, essentially, looking to catch up a little with some of the US trade of yesterday. But CAC 40 futures down 0.2%. Elsewhere, slightly more muted expectations for a little bit of negativity at the start of the trading day. So here it is, the start of European trading then for this morning, for the 3rd of January. And the FTSE 100 is slightly negative this morning, but wait for other markets to join in the fray, shall we? Yesterday, the big story around risk aversion, of course, extended to a number of assets. We saw the dollar on the rise. We saw yields on the rise. Today, we see a little bit of backtracking from that, but the dollar actually fairly flat overall, but the pound finding some space to rally, as is the euro. So a bit of movement on FX markets. Back to equities, and a few more of those markets are open, but not moving all that much, hence the greyness of that column, perhaps fairly usual for the start of a new year. This is the sovereign bonds column. Then we see a continuation of yesterday's themes with the risk aversion, meaning selling of sovereign bonds in this particular case, and some of those yields going higher. Commodities, a fairly mixed bag. After yesterday, we saw quite a bit of weakness around commodities, as I mentioned earlier on. Let's have a look at the sectors picture then and see if anything stands out there. Yesterday, this was a sea of green at this stage of the trading day, but today looks a little different. We're flat overall then. The stocks here at 600, just fractionally below the flat line. But banks is one sector that is making some headway this morning. Personal consumer goods also moving higher, and insurance. So we have some sectors moving higher. A mixed bag then across European stocks this morning. Sam Unstead joins us from our Markets Today blog. And I suppose the thing that stands out on the trading day ahead, well, one of them anyway, Sam, is the Fed minutes. But we were having a really interesting conversation earlier on in the programme about, you know, since the Fed meeting, and the markets kind of ran away with themselves with expectations of rate cuts this year in 2024. Since that meeting, a number of Fed officials attempted to push back against market exuberance and market enthusiasm for the rate cut story. And the markets kind of shrugged that off, not yesterday, but that was the narrative up to yesterday. And so in that context, you wonder what difference the minutes are going to make.
Yeah, I think that's true. I think the minute's likely today to just back up that kind of dovish message. You know, that is the narrative really going into this year for central banks more broadly. I think for assets yesterday, and actually, if we move to today, in fact, assets today, and you know what we are seeing in the moves today, feels more like what we were maybe expecting to see yesterday. And actually, what we ended up seeing was quite a big retrenchment of a lot of the moves that had happened more fiercely over the course of December. So only a small change compared to the bets that were made in December, but a bit of a pullback. And now I think as we come into this week, and we've got a lot of more data now coming along, this is perhaps more the day that I would have expected to see yesterday, but we had a much more exciting one in the end.
Yeah, well, exciting for not necessarily good reasons.
Yes,
it depends how you're positioned, I suppose, but it was exciting. And things can be exciting without a lot of volume, as you made the point in our last conversation, Sam. Let me ask you about the job story in the US, because we're building towards the end of the week. You know, we're back with a bang in terms of data points, because we'll get the non-farm payrolls data. In the run-up to that, though, we get JOLTS today, job openings. The broad trend there has been for those job openings to fade since the spring of 2022, but there is an expectation that ticks up a little today. So that's in the sort of immediate market mind as to what we're watching, but we're building towards the non-farm payrolls on Friday.
Yeah, that's right. The JOLTS data is still very much worth watching for that kind of trend. I think, the expectation is there's going to be a little bit of a tick higher, but probably not enough to really change that narrative. It would need to be, I think, a very significant beat to really sort of put the cat amongst the pigeons there. The payrolls report really is the one to watch for this week. As we just mentioned, the Fed minutes likely to back up that dovish message. The voters this year also are slightly less hawkish than the ones we had last year, so that will that narrative is likely to stay unless you get a really big surprise one way or the other on payrolls.
Okay, so we'll watch the payrolls as ever. Let me pivot to the UK conversation, but actually they're a little linked, because if the markets are expecting too much in the way of rate cuts from the Fed, then we ask ourselves, is that the case for the Bank of England as well? And certainly that seems to be the view of a number of our guests. We've spoken to 3 guests so far this year on this programme about the Bank of England, and all of them agreeing that the market is expecting too much and perhaps too soon in terms of rate cuts.
Yeah, and that is actually something that came up a lot towards the end of last year too, that these bets on the BOE almost moving in tandem with the Fed, maybe slightly behind with the ECB too, but actually when you look at the data, it doesn't really speak to that. The inflation has been a lot stickier here. It is going down, it is moving in the right direction, but getting back to target, it seems like that's quite a long way out yet. So yes, you may well see, very likely you'll see rate cuts come, but it may well be indeed that the BOE lags the Fed and the ECB.
Yeah, and so those rate cuts might not come as soon as some want. For example, we've heard from the IOD overnight, haven't we, the Institute of Directors, and they're calling for rate cuts. They say an early cut in interest rates would be justified in terms of helping to kickstart business confidence. So they track business economic confidence, and they say that has retreated in the month of December. But, from what our guests are saying, we might have to wait some time for those rate cuts.
Yeah, that's right. And I can say this report from the IOD, not enormously surprising, but you are moving into 2024 when, yes, there's a narrative of rate cuts, but there's also a narrative of a weakening economy. And these are companies that have debt. They want to see a sort of better picture, and they want a little bit of certainty about, when the first rate cut is going to come, and then how deep those cuts are going to be, so that they can kind of plan for the future there.
Sam, thanks very much. Thanks for joining us. Sam Onstead from our Markets Today blog. You can get more from the team that puts together the blog. Go to the Bloomberg UK website. You can click through to the blog from there, or you can type TLIV Go on the Bloomberg terminal. Let's take a look at some of the big items on the agenda for today, and a couple of them we've mentioned already, but the big US economic data point today will be kicking off with ISM manufacturing. That's at 3 p.m. London time. Mark was telling us his high expectations for that based on the Korean export indicator. Bloomberg Economics expects it to modestly increase in December, with improvement in new orders in the prior month supporting production activity. At the same time, we get November JOLTS data. Economists predict that the number of job openings will hold steady at 8.73 million in November, after falling by more than 600,000 jobs in October. Then at 7 p.m. London time, it's the big event of the day, if you like, for markets. FOMC December meeting minutes. Fed Chair Jerome Powell's dovish pivot at the mid-December press conference unleashed a global stock and bond rally. Since then, several FOMC members have walked back Powell's comments. We'll see whether the minutes reflect that and whether money markets have accurately priced in this year's anticipated Fed rate cuts. Coming up on the programme, no doubt we'll pick up on some of the themes around interest rates, but we'll discuss a really interesting conversation coming up. Disruptive megatrends shaping investors' thinking in 2024. We will get to thematic investing next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He
story.
is there to kind of upside.
Report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December Jobs Report, Friday on Bloomberg Television and Radio.
This is Markets Today. We are 10 minutes into our European trading day. Pretty flat across European equity markets. A little bit of upside on the London market, but essentially fairly flat for the second trading day of the year. Looking a little calmer than yesterday, that's for sure. Now, 2023 was a year of accelerated innovation, driven in part by the boom in AI. This year, disruptive themes across technology, sustainability and demographics are poised to generate new opportunities and risks for investors. So how do we invest around those? Let's talk to Martin Briggs, thematic investing strategist at Bank of America Global Research. Martin, really nice to speak to you, and Happy New Year. So you've been holding a number of events, writing some research, focusing on thematic investing themes, and you can't move for AI in that particular arena, I'm sure, right now, given the year that's played out. So when we look ahead then on AI, I know that you've said ahead of our conversation that commercialization of those AI opportunities is going to be crucial. What are you watching for?
Absolutely. Well, Happy New Year and good to be back. So I think firstly, as you say, 2023 was very much the year of AI and how investors pivoted towards technology and how generative AI could disrupt pretty much every industry across the board. What's going to be different this year, we think, is looking towards how some of those technologies could be commercialized. We saw for the first time where these models could become multimodal, so not just using them for text, but also for creating videos, creating images. I'm sure many have been using them over the Christmas period. But what's next, as you say, is how to make money from that. And so far, we've seen a lot of investment towards the big tech companies as well as the hardware companies enabling AI. We think now there's going to be a lot of opportunities for a number of different companies, both public and private, that can enable the next wave of AI that's going to go into beyond just the digital areas, but into some of the more physical areas,
yes,
simulation, etc.
And on the physical side of things, and we were just playing some images that showed, robotics and the forefront of that, and that's going to be an area of focus, moving beyond the digital into the physical world. I mean, too soon perhaps for a robot in my own house, but what are we talking about here?
Well, potentially there's a few applications. So robots is one. We had one at a recent conference whereby the interesting trend for us was how these robots have been around for a while, but they would take months to program them, to have a conversation. Now you add large language models and generative AI, and you can do that instantly. It's still a little bit of latency that needs to be improved with more computation, but those robots can now effectively communicate, probably more so for entertainment and hospitality purposes, but they've really been accelerated because of generative AI. So the next wave might be for more industrial use, areas around the home, companionship, etc. But I think the more interesting robotic applications we'll see in the next couple of years will be around things like autonomous vehicles and even flying vehicles.
Okay, I mean, I've got a big to-do list at the start of 2024, so I could do with some assistance. Maybe that guy can help me, the one we're showing on the screen. Let me ask you about how these themes play out then, when you invest around them. And I know you've put out a theme watch report recently talking about how they have actually performed. The thematic universe, you say, is currently trading at a discount versus the broader market benchmark. So I mean, you don't think cheap when you think AI. You think that sounds expensive. But some areas of thematic research actually playing out, looking really quite reasonably priced, you think?
Absolutely. But I think the interesting, or the thing to note with thematics is that things can change very quickly, right? If we'd had this conversation probably just over 12 months ago, obviously now ChatGPT is just over 1 year old. If we'd had that conversation before it would launch, then big data and AI would not have been the first conversation that we had. So things change very quickly, and it tends to be very catalyst-driven. We think for the year ahead, technology, AI in particular, is still key, but towards the end of the year, when you have events around COP29 and sustainability, we've recently published a big water primer, for example, because we think there's now a realization of water scarcity and some of the technologies that can mitigate that. So I think things will probably shift a bit more towards some of the industrials and the water technologies and things like that throughout the year. It's not all just big tech, but for now, that's very much where the interest resides.
Yeah, and sticking with the big tech theme for a moment, I mean, you talk about ChatGPT having its Netscape moment, and for those with shorter memories, this going back to the launch of a browser that basically allowed people to access the internet, to search online. And you think ChatGPT is performing something, a similar function there. This is a sort of live debate, isn't it, within tech circles at the moment?
Absolutely. I think the most important thing here was the democratization, right? So it's that kind of, and this brings two things. One is that millions or billions of people can now use the technology. That's great. It democratizes access, but it also brings awareness from both corporations and regulators to what some of the risks might be. So, we've seen a lot of AI summits and regulation and talk about what might come. We'll see much more of that in 2024. Our view is very much that a lot of jobs will be impacted, more will be created. It's going to be a net good for society, but it has to be embodied with the right kind of AI ethics, that human-driven approach that, technology is there to serve us, not the other way around.
How do you overlay sort of geopolitical concerns on top of the thematics, or do you leave that to others? I'm thinking here about, where do in which geographies do these thematic opportunities reside? Thinking about technology, is it all in the US? Is some of it actually in China, other parts of Asia? But clearly there might be geopolitical issues with some elements of the Chinese investment case.
Absolutely. I mean, sadly, you can't avoid geopolitics in all of these themes at the moment. It started off first on the climate technologies, where there's a kind of race to access the resources for things like battery, wind, solar, and renewables. It's now gone far more towards access towards the GPUs and the hardware needed for AI, and going forward will probably be the same in the next space race and quantum computing. So net-net, I think every region has a different agenda here, right? The US is looking to maybe export and keep control of some of that technology. China wants to use that for maybe surveillance purposes and is already deploying it. Europe wants to have very clear guardrails around how it can be used. So ultimately, the technology will be the same, but deployed in very different areas and regulated in different ways. And that's where we see geopolitics having a different view around the world as to what these themes and technologies will look like in the years to come.
And then the commercialization might look different, I suppose, in those different geographies. You mentioned water. That's another investment theme. Energy storage, also something that a lot of investors with a sort of thematic leaning want to talk about. Where are we in that story, Martin? How much of that is still to play for?
Yes, there's still a lot. I mean, if we'd had this conversation maybe a couple of years ago, obviously the focus was around energy security. A big part of that was access to renewable energy. The missing part was around storage. So we think, huge opportunities around things like both hydrogen storage, battery storage, and also just improving the grid infrastructure to be able to accommodate the level of renewable energy that's going to be needed to achieve the net zero targets for this decade and beyond.
Okay, thanks so much, Martin. Thanks very much for joining us. Martin Briggs, thematic investing strategist at Bank of America Global Research. Really interesting to think about the prospects there for 2024. Let's get a check on some of the individual stocks that are moving this morning. Chrissy Gupta has a briefing. Chrissy.
Yeah, good morning, Anna. We are talking a little bit about some deal news here, which is moving some of these stocks in a really, really big way. Of course, we're talking about that 1.8 billion euro deal that has been reported on. This idea that Airbus, which of course is the giant in aerospace and defense, is going to be looking to Atos, the French company, the French insurance company, I should say, and look at their cybersecurity unit to really dive in and expand their defense portfolio. What does that deal do to the share price? Atos shares higher by 3.6%. Earlier in the trading session, though, it was higher by as much as 5.5%. So pairing some of those gains, but still a pretty substantial jump there. Airbus, on the other hand, classic M&A deal, down by 0.6% as the acquirer. The other major story that we are watching is the read-through on shipping companies. The Red Sea, of course, very much in focus. Maersk, again, taking a step back and saying we are halting all passage through the Red Sea. We know they had momentarily restarted some of those shipments only to pull back again. But again, when you do see those pauses, it's all about the margins. The shipping companies actually do better when those rates increase, and that's why you're seeing Maersk shares higher by 4.4% and really setting setting the tone for other shipping companies as well. Hapag-Lloyd higher by almost 5%. And Anna, to round it all out, I'm going to put one more story on your radar. This coming from Ryanair. Those shares dropping by about 3% this morning, all after basically saying that there's a short-term load factor warning that they're issuing. They're saying that they're expecting a removal for some of their kind of offerings on some of these online travel agencies to actually mean some sort of short-term less capacity that would end up meaning short-term removal. They're saying that this would only last in December and January, so you are going to see a dip in yields, but they fully expect to come back in the spring. But again, that news pushing those shares down by about 3%.
Chrissy, thanks very much. Chrissy Gupta with a briefing on some of those movers today. Coming up, another sector in focus, anti-obesity drugs could be worth $80 billion by 2030. We'll take a deep dive into a market that is getting a lot of attention from investors. That's next. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back. This is Markets Today. We are just coming up to 22 minutes into our European trading day, and fairly muted movement across European equity markets, but better than we had anticipated. The futures picture had looked negative. US futures have turned slightly more positive over the last hour or so, really quite flat, actually. Now, let's move on to some of the major news flow of the past 24 hours. Air crash investigators in Japan are searching for answers after a deadly runway collision killed 5 people. The crash in Tokyo involved a plane setting off on a relief mission to the country's earthquake zone. Bloomberg's Kurumi Mori reports from Tokyo.
A devastating start to the new year in Japan. First, a 7.6 magnitude earthquake in coastal regions. Now, a plane crash here at Haneda Airport in Tokyo just a day later. Nothing has been confirmed, but officials are looking into potential miscommunication between the cockpits and air traffic control. Japan Airlines Flight 516 coming from Hokkaido was trying to land. Meanwhile, the Coast Guard plane was set to take off to deliver emergency aid for earthquake victims. The massive explosion where the 2 planes collided left 5 Coast Guard members dead and 1 severely injured. Local media now reporting that the surviving pilot said he thought he was told to get on the runway and take off, while air traffic controllers say they instructed the Coast Guard to wait ahead of the runway. No official conclusion yet, but it's a tragedy on top of a tragedy. Kurumi Mori, Bloomberg News, Tokyo.
That update from Japan. Let's switch focus to a market that has certainly had a lot of investor attention over the past year. Bloomberg Intelligence says that anti-obesity drugs could be worth $80 billion by 2030. So far, it's a sector dominated by Novo Nordisk and Eli Lilly, but plenty of other players trying to get in as well. This morning, for a deep dive into the sector, we're joined by Sam Fazeli from Bloomberg Intelligence, who can talk to us about this fascinating theme. Sam, good morning to you. So let's start with Novo Nordisk and Lilly stocks. Will they still be the shining stars of the market in 2024? They've come a long way. I mean, Novo Nordisk becoming the biggest stock in Europe at one point.
Good morning, Anna. So far, i.e. yesterday and today, they seem to have held their share prices that they finished last year, and it's the rest of pharma and healthcare that seems to be picking up. So there seems to be, if you want to judge from a day and a half of trading in January, there seems to be a little bit of investor move saying, actually, we ignored a lot of other pharma companies with some of them with strong stories. So I'm not sure how the year will end for Novo and Lilly relative to the sector.
Okay, and that's interesting. So investors perhaps looking at the other neglected pharma stocks. Are we expecting much competition news in 2024 in the sector?
We are, actually. There's not necessarily that there will be seismic changes in the competition this year, because they're still likely to be the only two in the market. But we expect news from Amgen, we expect news from Pfizer, and that news will be, is it in the game or not? Does it then have to go and buy someone if it's not in the game? And we're also expecting news from a company called Zealand Pharma, which is based in Denmark, and they've been working in obesity too. Also a stellar share price rise in 2023 story. And that's a slightly different mechanism of action, so it's not necessarily competitive, but more getting into the game and potentially treating people who can't respond or have side effect issues with current drugs.
Okay, so clearly there's a lot of expectation around the sector, and we saw that very clearly last year. No doubt that continues. And you've then created these estimates as to how big this sector becomes. So talk us through what goes into your research then that comes up with these estimates for how big the sector can be.
So the 99.9% of the work on the deep dive is done by my colleague Michael Shaw, just to give him the credit where it's due. So this sector, I mean, it's always a dynamic between volume. Volume, we all know, is potentially massive, right? All we have to do is walk around. This is not something that you need to get some statistics from a cancer society. You walk around the streets, you see the potential volume out there. The question is the price. And there's still lots of pressure on the price to try and reduce the net price to the to payers. And the more important one in the US is the Medicare pricing. Medicare is who covers pretty much people over 65. That needs to come in 26, 27 potentially.
Okay, Sam, thanks very much. Thanks for the update. Sam Fazeli from Bloomberg Intelligence. Coming up on the programme, we'll get to another sector in focus. Despite Tesla exceeding its annual delivery target, it's been overtaken by BYD of China in global electric vehicle sales. So in terms of the last quarter of data at least, Tesla no longer the largest seller of EVs. That title goes to BYD. What does that mean for a car company that has been big in China? It's a big exporter now, threatening to overtake Japan in terms of EV exports. You can't buy them in the United States, though, so we'll get into that story shortly. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price-wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today. We're 30 minutes into your European trading day. Let's get to your top stories. European stocks tread water in a cautious start to the new year. Today's Fed minutes may signal whether last year's appetite for risk assets was overdone. Airbus has begun initial talks to acquire the cybersecurity and data unit of Atos in a deal that could value the business at as much as $2 billion. Plus, Tesla loses the top spot for global EV sales to BYD as it fails to outsell the Chinese automaker in the fourth quarter. Welcome back to the program, everybody. Just gone 8:30 here in London. Let's check on the markets for you. And this is the sort of treading water, lackluster picture we were pointing to in our headlines. Almost entirely flat on the Stoxx 600 this morning. A little bit of weakness there in Germany. And there was some early strength to the London market, but that seems to have faded. So we're pretty flat on all of these markets. The FTSE Mid, the worst performer, down 0.1%, though, so not by much. US futures flat to negative this hour. Let's have a look at the... we're really playing catch-up with the US story of yesterday. Let's have a look at the sector picture. And it's not terribly revealing this morning. We have around half of sectors, just under half of sectors, moving higher. Healthcare doing okay, food, beverage, tobacco doing okay. We were just discussing the healthcare sector with our colleague Sam Fazeli, who was saying that you're seeing some appetite for those companies that were perhaps overlooked in the obesity drug frenzy that we saw gripping markets last year. So that's part of the theme we're watching there. Basic resources, construction and materials, financial services, those are the sectors doing worse today. So we see basic resource stocks down by 1%. Interesting to think about commodities and where we are on the commodity story. Oil prices down 0.6% today, 75.45 on the Brent price. We saw iron ore, though, showing a slightly more positive picture, not by as much as yesterday. Expectation around some delivery from China may be one of the dominant themes there. Now, Tesla has now been overtaken by China's BYD in global EV sales for the very first time. That is despite Tesla delivering more vehicles than expected in the fourth quarter. Let's get the details now with Bloomberg's Aggie Cantrell, who's in Berlin. Aggie, good morning again. So how significant is this for Tesla?
So, hi, Anna. So firstly, when it comes to this BYD figure, as we pointed out, it is a single figure. It's about the deliveries in the last quarter of 2023. But that is significant because essentially what it is saying is that a major Chinese brand is essentially a real competitor within the EV space. But it's important to note that when it comes to revenue, when it comes to profit, Tesla is still ahead. It's not really about a competition between these two companies, though. What it really is about saying that the industry that Tesla really defined for a long time is seeing some real new players that are very significant and very competitive in their own right. And what BYD is doing in the EV space is different from what Tesla is doing because they're offering a broader amount of models, both both pure EVs and also plug-in hybrids, and at a lower price point. They're targeting a different market, a market that is attractive in China, in their domestic market, but also one that they're really trying to push externally and which they're trying to export to other regions.
Okay, and what does that mean for the global EV market that China is now? What does it mean for the global space, I suppose, that China is such a significant exporter of passenger cars? Worth noting, I don't think they export them to the US, but they export them to a lot of other places.
Yes, they don't export them to the US, but I think an interesting statistic about BYD specifically and about China more broadly is that in the summer of 2022, 1 in 40 BYD cars were exported outside of China. And now, as of December last year, that's 1 in 10. They are really stepping up that expansion outside of China. They see that they've really captured the Chinese market, and they're really pushing for them to go elsewhere. And a big part of that is the European story, is about whether they can get these cars into the EU. That's not just about BYD, but more broadly about Chinese automakers trying to push EVs in the EU that now account for about a third of China's EV exports. And that is the big question mark this year as we look at the EU doing this probe of China's subsidies of the EV market in China, and to see whether or not tariffs, significant tariffs might be imposed on the Chinese EVs if the EU decides that those subsidies are somewhat unfair for the European brands that are also trying to build out their EV offerings.
Yeah, we'll certainly watch those market access stories then through 2024, Aggie. On another subject that I know falls under your tech beat, Apple shares falling yesterday over a warning from one particular broker about soft demand for the newest iPhones. How much of a concern is that?
Yes, this came from a Barclays analyst, and essentially what I found interesting in this was that they were pointing to the fact that for so long, the potential new features on every new iteration of the iPhone have really been a driving force for consumers. But as we've seen a weakened demand in the consumer smartphone market over the last year, that hasn't the iPhone 15 launch didn't really offer features that were so exciting for the consumers to return and buy these extremely high-priced products. They are some of the most expensive smartphones on the market, and so of course the consumers have to be driven by new features and new things that are attracting them to it. And also another thing that is interesting to point out, though, is that this is an analyst pointing out that essentially their share price, the Apple share price, is bucking the trend of this consumer slowdown for smartphones, but really a lot of other people still remain bullish on Apple. And often, despite the fact that the share price, despite the fact that there has been underperformance when it comes to the iPhone sales in the last year, the share price has still overperformed.
Aggie, thanks very much. Bloomberg's Aggie Cantrell with all things tech for us this morning. Let's get to some of our other top stories on the Bloomberg terminal this morning. Harvard President Claudine Gay is stepping down in ending a short tenure marred by allegations of plagiarism and a campus controversy over anti-Semitism. In a statement, Gay says it's in Harvard's best interest for her to leave the job. Her exit is a dramatic about-face from her acclaimed start back in July as the university's first black president. Donald Trump has filed a lawsuit seeking to restore his name to Maine's presidential primary ballot. The state last week declared the former president ineligible for another term under the U.S. Constitution's 14th Amendment, which bars candidates who've engaged in insurrection. Colorado Republicans have already asked the Supreme Court to reverse a similar decision in their state. The social media platform X has started to re-show news headlines alongside links shared to the service. The move reverses a change that owner Elon Musk said had come to him directly from him, back in October. Critics of the original change said removing the news headlines made it more difficult to determine what articles other users were sharing. JP Morgan shares have hit a fresh record high for the first time in more than 2 years. Shares of the largest US bank have been a top performer in the sector as it posted record results last year, prompting Chief Executive Jamie Dimon to warn that the bank is over-earning in some areas. JP Morgan stock rallied 27% last year. The KBW Bank Index fell by roughly 5% over the same period. Despite the surging stock, Wells Fargo analyst Mike Mayo has demoted JP Morgan as his top pick among big bank stocks for 2024, going with Citigroup instead. Mayo told us he expects Citi to more than double over the next 3 years.
My top 3 picks for 2024 are Citigroup, Citigroup, and Citigroup.
Okay, all right.
And you could either consider Citigroup a 3-ring circus, or you could view it as 3 connecting circles, like a 3-circle Venn diagram. And I choose the latter. The first circle is their org simplification. They're delayering management from 13 layers. 13!
Yeah.
You know, from the bottom to the top CEO down to 8. They're eliminating 2 intercompany lines of business. They are organizing along 5 lines of business, and that's it. You know, do away with so much matrix management. That's kind of ring number 1. Ring number 2 would be their transformation, where they're finally modernizing their back office technology. And some of this is regulatory driven, but it's stuff that other banks are doing. And the third ring are these business exits. They're retreating from 14 non-U.S. consumer markets and some other businesses. So you take these 3 circles together, and you have the biggest restructuring at Citigroup in modern history. So the question is, does it turn out good or bad? And I'm saying it turns out well enough for this stock to double over the next 3 years.
Well, that's what I want to talk about, because, I mean, we kind of know what Jane Fraser's been trying to do. This is going to be, I guess, a somewhat slimmed-down company, or at least slimmer than what it was here. Does that automatically translate into better profitability?
I think the bottom line is that Citigroup is becoming a much more simple and profitable firm whose earnings should double over the next 3 years. But this is make or break time for Jane Fraser. You said, is this due to Jane Fraser? Maybe. I think so. But not definitely. I mean, to some degree, the feedback from investors has been for the last year, Citigroup's blown up the profit and loss statement due to expenses that are out of control. My view is they're ripping the guts out of the company, reconstructing it, and that costs money, but those expenses then start going down. And they've already guided expenses to go lower in 2024 and for 2025. So I think this is a combination of a much more optimized, streamlined, efficient firm and that'll drive returns much higher. That should drive the stock price higher. Now, we have several scenarios in my 50-page report. If there's a recession, I think Citigroup stock underperforms because they have a lot more credit cards. They're top 3 in that. But outside of recession, we think the stock doubles. In a bull scenario, I think Citigroup stock triples over the next 3 to 4 years.
Okay, so this isn't even the most optimistic scenario. This is like, if they get most of what they promised done, then the stock can double. What about the fact that lots of CEOs at Citigroup have tried to embark on reorganizations and haven't totally executed? I mean, history is not on Citi's side.
Well, you can read Exile on Wall Street. That's by me. Thank you for writing about it when I published it. And so, I wrote 2 of the 10 chapters about the failures of Citigroup. So I understand Citigroup's mistakes. But what's different this time is the result of this restructuring should be a much more simple Citigroup, not a more complex Citigroup. And that's night and day.
Wells Fargo's Mike Mayo speaking there to Bloomberg's Romain Bostic and Scarlett Fu, making the case for Citigroup. In other banking news, we will be speaking to Morgan Stanley's executive chairman, James Gorman. That conversation coming up a little bit later on today. Don't miss that exclusive interview. Coming up on this program, a senior Hamas leader is killed in a Beirut explosion. The details on that and what it means for the Israel-Hamas war, other tensions in the region around the Red Sea in focus as well. We'll get an update. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. It is just coming up to 8:45 here in London, 9:45 if you're in Paris or Berlin. A fairly muted session for European stocks. You can see pretty flat across most of those major European markets. We see a bit of weakness coming through in the French market. So the CAC 40 down around 0.4%. Not a great deal of storytelling in the sector breakdown. So let's have a look at what's happening on the movers front, because there are some individual movers that are giving us something to talk about this morning. The first of those is Maersk. This, of course, is the shipping giant, up by 5.5%. And it's been quite volatile, actually, in the context of some of the fast-changing policy announcements we've seen coming through from Maersk. This is to do with shipping companies sending their huge container ships and others through the Red Sea. And we heard from Maersk some time ago that they were stopping sending ships through. Then they reintroduced the passage through the Red Sea. And then we heard on the 31st of December, that they were once again stopping that passage through the Red Sea. And so as a result of today's, or the last 24 hours, we've heard news flow that they're continuing to suspend passage through the Red Sea. So all of that adding up to some movement higher in the share price. That stock up by 5.3%. The next one on there, we've got Atos, I think, if my eyes don't deceive me. That particular stock in focus as a result of, shares have been surging as much as 12% on that particular business, but then moving downwards a little bit from those earlier highs. The French tech firm has received an offer from Airbus for its cybersecurity and data unit. The company is still in discussions, we understand, with the Czech billionaire Daniel Kretinsky to sell the Legacy Tech Foundations unit. This is also part of the conversation around what happens to that business. So we'll continue to watch that. But the market responding quite positively to what we've heard from Atos and from Airbus. Also in focus, Roche shares. You can see those demonstrating some strength, up by 3.4% on the Roche share price. This is broadly just a picture of positivity around the healthcare sector. We were talking earlier on with our colleague Sam Fazeli, who was telling us that really what the market is doing at the start of this year is looking for pockets of the healthcare space that have not been aggressively bought already. So away from those themes around the anti-obesity drugs, and we know that story very well with the likes of Novo Nordisk and Eli Lilly, the market is looking for underbought stocks perhaps in that sector. So as a result, Roche doing pretty well. Ryanair also in focus then. That stock down though this morning, down by 2.75%, off earlier lows. It was off by a little more than that. The budget airline saying that the removal of its flights from several online travel agencies would reduce its load factor in the near term. So that's something. Distribution of those seats and the way that you can purchase those, clearly it could be something that weighs on sales at that business. So those are some of the movers this morning. Let's think about where we are on the market. Sam Unstead joins us from the Markets Today blog and can help us get to grips with some of the themes this morning. Sam, welcome back to the programme. Let me ask you about Fed minutes then. This is the big item we're waiting for. What are you going to be watching for in those Fed minutes, Sam?
I think everyone really was going to be watching for this dovish narrative that we're going into this new year with. New voters who are on the Fed as well are slightly less hawkish than those of last year. So I think everyone will be looking for that to be kind of solidified. And then that can allow everyone to really focus their attention on when is that first cut going to come, and then how deep are those cuts going to go.
And one of our guests earlier on was stressing, it'd be interesting to look in the minutes to see if there was conditionality attached to this pivot to more dovish policy. That could be the kind of detail that perhaps the market clings to, because we've heard from Jerome Powell in the press conference, we've heard from other policymakers since then kind of pushing back against his more dovish narrative. So we'll watch that. And then I guess at the end of the week, our attention shifts to the jobs report.
Yeah, and actually, so I think what you'll see in those Fed minutes and what we heard from in that pushback as well is the same message that we had for most of last year, which is data dependence, that we will sort of stand ready to change policy if the data goes in the wrong direction. We're expecting a slightly stronger jobs report for December. Probably not strong enough to really change that narrative, but if there is a big upside or downside surprise, that could change the narrative ever so slightly. But I think what we're really expecting to see from that is a continuation of the story where the economy is weakening, but not too much. So almost exactly kind of what the Fed would want to see.
OK, if we're not done with celebrating over the last couple of weeks or so, Sam, we have something else to celebrate this morning, the 40th birthday for the FTSE 100. What do we make of it in its middle age?
Well, I think it's not as strong and vibrant as it used to be. I think so. If you look at the performance chart, we've talked about this a lot over the last few years. That dearth of tech stocks in London has meant that it has really been left behind, particularly when it comes to comparison to US stocks. Sort of started in the piece by John Authers today. There's a nice line in there that it sort of started just after the global financial crisis, but has really accelerated over the course of the last sort of 5 or 6 years. And this sort of speaks to this issue that I think we'll be spending a lot of time speaking about again over the course of this year, which is improving the standing of the London market, as far as valuations go, as far as getting new IPOs onto the London market. So, yeah, it's a 40th birthday, but perhaps not the happiest 40th birthday it could have ever had. OK, yeah, maybe not celebrating with all the friends present and family. Thanks very much, Sam, for joining us. Sam Unstead from our Markets Today blog. You can read all the stories being covered by the Markets Today blog team. Go to the UK website or type TLIV Go on the Bloomberg terminal. More on the markets ahead. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere.
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Welcome back. This is Markets Today. We are 53 minutes into our European trading day, and stocks pretty range-bound, treading water this morning. The Stock 600 is flat, as are most of the major markets. The French market underperforms a little bit, down by 0.5% this morning. Let's get to some of the things that we are focused on today when it comes to markets. Ven Ram joins us from the Markets Live team, live from Dubai, in fact. Ven, very good morning to you. Let's start with the Treasuries market then and the outlook for 2024. You've written a piece this morning where you say markets are sending out a message of caution on Treasuries in 2024. Big questions about whether that yield story has fallen too far. We're seeing something a little different perhaps at the start of this year. Can you elaborate?
Morning, Anna. I mean, if you look at what Treasuries have done in the past 2 months, November and through December, you've seen the two-year yield come off by 85 basis points. Now, if you take the Fed at their word that they're going to cut rates by 75 basis points, we have priced in all the 3 rate cuts and probably a bit more from the Fed. And if you look at the 10-year, we've got to 3.8%, and that's a 100 basis point fall in the space of just 2 months. That's a humongous amount of rate volatility to uncork. Now, if you look at the 10-year yield at 3.80, and given crumbling inflation that is likely to go below 3%, you're thereabouts. You have attained fair value, so there is not too much of a gain to come by from here. If you look at the the two-year maturity is overvalued by a whole lot. That means that we need to correct higher, and the yield has got to go to 465, 475 thereabouts over the short term.
Okay, so that's the story around Treasuries. What are you seeing in stocks then, Ven?
It's pretty much a similar story, Anna. If you look at technology stocks, I mean, we saw a humongous run-up in the last 2 months of the year again, and NASDAQ was already overvalued to start with, and at current levels, the index is overvalued by some 30 to 35%, depending on the day. I mean, the fair value of NASDAQ is about 12,877 on my model. So stocks have run up a whole lot, and they are already assuming that the Fed's discount rate is somewhere about 350. So I don't think stocks have, too much room to run up from here.
The inflation story globally, for developed markets, is one where we're kind of getting on top of inflation. Inflation rates coming down pretty aggressively, Ven. In Turkey, seeing something else. It looks like in that particular emerging market, the peak in inflation is still months away. What do you make of the data out this morning on inflation there?
Well, we saw, on-month inflation slow a bit, but we saw the annual inflation still nudging around 65%. That's a whole lot. But the central bank has taken decisive measures in the past 6 months, as you know, and they've raised rates by a whole lot. And that means that the real policy rate is not so deeply negative as it was at the start of last year. And that augurs well for the lira. Its worst phase, it seems, is in the rearview mirror now. And if there is a disinflationary narrative that takes hold in the second half of 2024, as is expected to, and if the current account deficit improves, I think the lira may improve in the coming year.
Okay. Ven, thanks very much. Thanks for joining us. Ven Ram from our Markets Live team. Remember, you can get up-to-date analysis and insight from Ven and Mark and the rest of the Markets Live team. MLI Vigo is the function to use on the terminal. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London in for Francine Lacqua. Here's what's coming up on today's program. The New Year hangover is one of the weakest starts to a year for stocks and bonds in over a decade. Today's Fed minutes, however, may signal whether investors thought last year's rally was actually overdone. Meanwhile, in deal news, Airbus begins initial talks to acquire the cybersecurity and data unit of Atos in a deal that could value the business at up to $2 billion or 1.8 billion euros. Plus, a new leader in the global EV race as Chinese automaker BYD outsells Tesla for the first time in history. Let's take a quick look at the European markets map, though, because, of course, we know the European trading session is starting to pick up a little bit. You are seeing a risk-off sentiment, though, something we saw in futures across the board. You are seeing some underperformance, specifically in kind of the periphery, the Italian MIB, for example. But what's important to keep in mind is that it is still very thin holiday trading volume. The first week of January is seasonally always going to be very weak, and it's also going to be kind of a moment where some moves may actually be exaggerated. I'll give you just one example. That's the equity picture you're looking at, but even in the bond market, you're looking at a 10-year yield of 3.98, higher by 5 basis points among just a handful of trades because, again, very, very thin holiday trading volume. Actually, that's where I want to start with our markets guest this morning. Derek Halpenny, head of research, global markets for EMEA and international securities at MUFG, joins me right here on set. Derek, pleasure to have you on the program. Morning. What do you make of this move, a 10-year just shy of 4%?
Yeah, as you mentioned earlier, I think you have to take it in the context of what's happened during, well, if you go back to the highs in yields in October, 85 basis points in the 2-year, 110 basis points in the 10-year. Equity markets have rallied 16% from the low point in October. So we've just had this big risk-on trade with yields coming down as the markets price in more and more rate cuts from the Fed. And I think it's an understandable, rational question to be posing at the beginning of the year. Was it overdone? Was it positioning? Was it technicals? And all of that kind of plays into, I think, the appetite to prompt some correction, like what we're getting.
Well, speaking of corrections, let's talk about the dislocations in the market as well. We're talking a lot about the yield story. It feels like the dollar has kind of been marching to the beat of its own drum, partially driven by the rate cuts that are getting priced in the market, but also partially driven by some of the positioning that we're seeing. And yet, here we are talking about potential recession in parts of the world, and we're looking at euro dollar at 110, cable at 126. Talk to us about your dollar view.
Yeah, well, I think that's actually one of the highlights that we have in terms of the reasoning why we think the dollar is going to recover before possibly weakening later in the year. And ultimately, we don't expect any kind of big move weaker, i.e., let's say, for example, a depreciation of the dollar of north of 10%. If you go back to 1990, there have been 6 periods when the dollar has weakened by 10% or more. On every single occasion, that has coincided with a positive global growth backdrop, either coming out of crises like the global financial crisis or COVID, or in Europe, the strength in growth in 2017. Every example, there was a positive global growth story. And I struggle to come up with a positive global growth story for this year. We may stabilize at these weak levels, but the consensus is that we drop marginally. And that's just not a kind of a global backdrop for a sustained sell-off of the dollar. So that's why we think the challenges that lie ahead, that could be more obvious possibly in the first half of the year, as real yields, real policy yields continue to rise as inflation falls. That will be challenging for the dollar to weaken, and I think we're going to see some recovery.
But let me push back on that narrative here. One of the tailwinds for the economy that might potentially drive, excuse me, global growth is consumer resilience. At the end of the day, you were talking about this kind of drop in inflationary numbers. Doesn't that kind of create a built-in tailwind for consumer spending around the world, which would then factor into the global growth story you're talking about?
Yeah, I think it will take time for certain elements to kind of feed in and start to become evident in the economic data. And that's why we have the dollar weaker story, more of a second half of the year story. Yeah. So, for example, China, we're seeing a lot of policy implementation taking place at the moment, but there's a lot of challenges still there at the moment, and I can't see growth picking up any significant way over the first half of the year. So I think from that perspective, it's not really a positive story yet. And in Europe, certainly the data at the moment is not indicative of any kind of imminent pickup in growth. So while I get what you're saying, I would still say that the monetary transmission mechanism, which we think will reverse after the easing in financial conditions that we've had in November and December, will act as a headwind, if you like, in the earlier part of this year.
Well, let's talk about the ripple effects then. If you're talking about dollar strength, do we then revisit euro-dollar parity, for example, which is something we discussed just within the last 12 months? Do we discuss sustained weakness in the pound? What kind of numbers are we looking at here?
Yeah, again, I emphasize the fact that we're not expecting big moves one way or the other. Flipping it the other way, it's very hard to be uber bullish on the US dollar when the Fed will be cutting rates this year. And they'll probably be cutting rates by the end of this year by more than most other G10 central banks. So in that context, as long as the pricing in the rates markets remains consistent with that story by the end of the year, there's going to be, impediments to a big period of dollar strength. So to answer your question specifically, 106, possibly 105. I'd be surprised if we broke 105. If you look back at euro dollar, whenever we've broken 105 to the downside, there's been significant macro events that have explained that move. And if that doesn't happen, I think, breaking below 105 is going to be difficult just on the kind of relative macro story that plays out.
But how much of that is a function then of capital flows, for example? Some of your colleagues who would be in the dollar bull camp, as you are, would say that it's the capital flows narrative, the idea that weakness in Europe or weakness in Asia would then create some sort of underlying bid, not just for the dollar, but for American assets broadly. Are you saying the capital flow story may not overrule the rate story?
Well, I think, to answer that in part, obviously you need to look at valuations, and, equity markets have done well everywhere, but of course the US has outperformed, and certainly from a valuation perspective, I think equity markets globally are a lot cheaper than what they are in the United States. So I think from a capital flow perspective, and then of course you have to add in on top of that the current account story, and that is obviously less favorable in the US than it is, say, in Europe or certainly in Japan.
Well, factor that in for us then. We're going into a US election, a fiscal deficit, and yet people still buy American assets in a crisis. What's up with that?
Well, it's the largest, most liquid capital market in the world. So if there's a rush for safe haven assets, that's what's going to happen, and the dollar would certainly strengthen. So, in terms of our view, if there's going to be volatility, we'd expect that perhaps in the first half of the year rather than in the second half of the year. But of course, if there's a big risk-off event, then the dollar weakening by the end of the year is probably not going to happen. So you always have to factor in that risk. But we're not, I guess, penciling in a kind of a financial crisis type event that would fuel substantial further dollar strength.
But then you do, of course, have the conversation of the fiscal deficit, the current accounts, as you just talked about. How do you even trade on something like that? After the U.S. Presidential election, the very first thing the new or incumbent president has to do is deal with, again, raising the debt ceiling. So January 2025, first line item. How do you price in something like that? How do you trade something like that?
Well, I think, in terms of those points specifically, those are very difficult to price and to trade, and those are elements of uncertainty that are inevitable that will come forward. I think from a rates and an FX perspective, it's about, let's say, assuming Trump was to win, it's about his trade war policies and what that might do, and secondly, his ability in terms of implementing fiscal stimulus like he did in 2017. And I think given the fact that the tariffs haven't really changed from what he implemented back in 2018, the impetus for that to strengthen the dollar is a lot less than it was in 2017. And then, of course, his constraints, I think, in terms of further fiscal expansion, given where we are in terms of U.S. debt levels, again, I think is a lot more constrained than it was in 2017, 2018. So the impetus for dollar strength based on what happened when Trump won in 2016, I think is a lot less now than back then.
An interesting comment to watch at a time when President Trump may or may not be the Republican nominee. We, of course, the jury's still out on that, but certainly to your point, something a lot of people are watching and even assuming in their base trades. Derek Halpenny, we have to leave it there, but we thank you so much for your analysis. He, of course, is the head of research and global markets for EMEA and international securities at MUFG. Plenty more ahead. Stick with us. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Hamas says Israel has killed one of its senior leaders in an explosion in Beirut. Lebanese media say an Israeli drone struck an apartment building in the capital, killing the deputy head of the Hamas Politburo and 5 other people. Israel, on the other hand, has not confirmed it was behind the attack. Joining us now for more context on this, Bloomberg's Sam Dagger joining us out of Riyadh. Sam, can you talk to us a little bit about the Beirut blast specifically in the context of the conflict?
Absolutely. Good to be with you. Saleh al-Aruri, this Hamas leader, was actually one of the co-founders of the Qassam Brigade, which is, which led the attack on Israel on October 7th. So he's a key figure. And beyond that, he's been instrumental in trying to establish or expand Hamas's presence in the West Bank beyond Gaza, and also to strengthen the ties between Hamas and Hezbollah and Iran as part of the so-called axis of resistance. These are proxy groups that work very closely with Iran, be it in the Palestinian territories, in Lebanon with Hezbollah, in Iraq with the militias there, in Syria through the Syrian regime and militias on the ground, and obviously in Yemen as well. So he was an instrumental figure. And it seems like after October 7th, both the U.S. and Israel are going after key figures in this network, because last week we had Israel, it didn't come out and confirm it, but all indications it was Israel assassinate one of the top Islamic Revolutionary Guard Corps commanders, Iranian commander in Syria, who was orchestrating attacks both on Israel and U.S. troops in northeast Syria. And then also the Biden administration came out last week and ordered retaliatory attacks against Iranian proxies in Syria. So I would put it in that context.
Well, speaking of the context, I think for a global audience, it's important to understand the dynamic between Aruri, as you point out, and what he was actually doing in Lebanon. Where does Lebanon fall in all of this?
Great. I mean, obviously, all eyes are on Lebanon, and all eyes are on whether Hezbollah is going to respond to this, because this happened in one of the most secure areas in the southern suburbs. You could call it almost like the area where Hezbollah's command center is in the southern suburbs. So obviously a very significant security breach, and everybody is waiting for the Hezbollah leader, Hassan Nasrallah, to come out later today to weigh in on this. I mean, he was scheduled to speak anyway, but obviously this will be front and center. But I would actually think that maybe this time the response will not come from Lebanon. It will maybe come from elsewhere, because that seems to be like the pattern right now. I mean, with this network that Iran has built, I mean, they're all working in unison, whether in Lebanon, in Yemen, in Gaza, in Syria, and Iraq. So we may well see the response come from Yemen. I mean, we don't know, but all eyes are in Lebanon still.
It's really something we're watching very, very closely. Of course, the geopolitics and the dynamic in that region. It's a very dire and sensitive situation. Bloomberg Sam Dagger joining us from Riyadh for that crucial context. We thank you as always. I want to get to other top stories. Air crash investigators in Japan are searching for answers after a deadly runway collision killed 5 people. The plane was on course to deliver relief to the country's earthquake zone. Bloomberg's Kurumi Mori reporting from Tokyo.
A devastating start to the new year in Japan. First, a 7.6 magnitude earthquake in coastal regions. Now, a plane crash here at Haneda Airport in Tokyo just a day later. Nothing has been confirmed, but officials are looking into potential miscommunication between the cockpits and air traffic control. Japan Airlines Flight 516 coming from Hokkaido was trying to land. Meanwhile, the Coast Guard plane was set to take off to deliver emergency aid for earthquake victims. The massive explosion where the 2 planes collided left 5 Coast Guard members dead and 1 severely injured. Local media now reporting that the surviving pilot said he thought he was told to get on the runway and take off, while air traffic controllers say they instructed the Coast Guard to wait ahead of the runway. No official conclusion yet, but it's a tragedy on top of a tragedy. Kurumi Mori, Bloomberg News, Tokyo.
I want to stick with the story in aviation, this time in the deal space. Shares in Atos have given back earlier gains. They said it was in talks with Airbus over the sale of its big data and cybersecurity unit, a deal that could be worth up to 1.8 billion euros. But Airbus saying there's no guarantee that discussions will actually lead to an agreement, and Atos saying it's already had interest from another party. And of course, those Atos shares higher by about just shy of 2%. They were higher originally at their European Open at about 5%. So very quickly paring back some of those initial gains. Coming up, we discuss more on the transportation sector, this time with Tesla exceeding its annual delivery target. It's been overtaken by BYD over in China in terms of global electric vehicle sales. We'll bring you the story next. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Could face bigger challenges next.
It was going to keep Real World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Here he is trying to compete. Why do you laugh?
Have you seen their car?
I have seen their cars, yes. In fact, at the Berkshire Hathaway meeting, I saw their cars.
Yeah.
Well, they're on a different, tell me why you're laughing. You don't see them at all as a competitor?
No.
That was Elon Musk speaking to our former colleague Betty Liu back in 2011, saying that Chinese EV maker BYD may not even qualify as a Tesla competitor. Of course, Musk has already publicly changed his view since then when it comes to the Chinese electric vehicle maker. He posted this back in May last year, saying that their cars were now, quote, highly competitive. A real 180 when it comes to Elon Musk's take on, of course, BYD. In the meantime, Tesla has been overtaken by the company in global EV sales for the very first time in history. Despite Tesla delivering more vehicles than expected in the fourth quarter, the change reflects China's growing influence in the automotive industry. For more on that, let's bring in Bloomberg's Craig Trudell, who's been here with me in London. Craig, this is a really interesting dynamic because back in December, we got some of these delivery numbers for a lot of the Chinese EV makers, and they did not perform well. And still, Tesla doing kind of okay. Tell us more.
Yeah, I mean, BYD, I would separate them from a lot of the other Chinese car makers where, you know, you're seeing really a two-horse race here where you do have BYD and Tesla, you know, sort of head and shoulders above everybody else, both in China and globally, I would say, from an EV perspective. But this absolutely is a case of a company that, you know, back in 2011, there was a reason to kind of snicker at BYD's cars. They were not very attractive. They were not particularly competitive. But this was a company that has kind of out-Tesla'd Tesla. They are, you know, employing a lot of the same strategies, being vertically integrated and sort of, you know, in control of their own destiny and making a lot of the components that go into the cars themselves. And particularly in batteries. That's really their specialty. And the competitiveness of their batteries from a cost perspective has really gone a long way to putting them in a position to where, you know, last quarter really wasn't even close. BYD pulled ahead of Tesla by quite a large margin.
How much of this is a question of where the market actually is? Because BYD sales are largely driven by the Chinese consumer. Tesla, a slightly more global company. Is this really still significant to the global EV story, or is this China?
Yeah, I think it absolutely is the case that, you know, we talk about EVs as sort of dictating the future of the auto industry, and, you know, China is you know, far and away ahead of the rest of the world in terms of, you know, getting an EV industry up and running, both from a manufacturing perspective, a supply chain perspective, and from a demand point of view. And so, you know, this is extremely important that the rest of the industry, you know, play some catch up. We've seen domestic car companies in China really pull ahead of foreign car companies, and unless that changes, it's not going to be a good trend by any stretch of the imagination for the rest of the industry.
Well, Craig, one of the things we've been watching very, very closely is, of course, Tesla's share price. We know it's a giant in the S&P 500 and, of course, indices around the world. And one of the things that impacted the Tesla share price was Elon Musk's acquisition of Twitter, the idea that if he changed focus from Tesla, Tesla might fall behind and then pressure the stock. It was a whole saga, as you remember. Is he the one responsible for falling behind this time around?
I think just to maybe give a little bit of a preview of today's Hyperdrive newsletter, we'll look at this and just, I think for me what stands out from the Walter Isaacson biography that was published last year was, Musk 3 years ago said that he believed Tesla was going to be able to market a $25,000 Tesla in about 3 years. That is now looking like a proposition that may be, yet another 2 or 3 years away. And what was interesting about that biography was it sort of, described the extent to which Musk himself really, in Isaacson's words, repeatedly vetoed that project. And he got in the way of that. If they have a more affordable Tesla to offer, it absolutely would change the competitive dynamics here.
Yeah, we'll see if Tesla actually still has a little bit of fight left in them. Bloomberg's Craig Trudell, we thank you so much for that crucial analysis. Coming up, we continue the tech conversation, this time around AI. Stick with us. This is Bloomberg.
Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The New Year hangover, it's one of the weakest starts to a year for stocks and bonds in over a decade. And on today's Fed Minutes may signal whether last year's rally was indeed overdone. In corporate news, Airbus begins initial talks to acquire the cybersecurity and data unit of Atos, a deal that could value the business at up to $2 billion or 1.8 billion euros. And more corporate news, the new leader in the global EV race is Chinese automaker BYD outsells Tesla for the first time in history. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. The big conversation of 2023 was all about AI and whether or not this kind of excitement around the technology was accurately priced into the market on either direction. The idea here is perhaps it fueled stocks to those record highs, but did it maybe go too far? Bloomberg Intelligence, for example, saying the generative AI market is set to reach $1.3 trillion. That is trillion with a T by 2032. But as the market grows, countries, companies still grappling with how to actually regulate it. In December, for example, the EU making a critical step with a landmark AI policy poised to become the most comprehensive regulation of artificial intelligence in the Western world. Joining me now to discuss, Samisha Ferdinand, financial services lawyer at Ferdinand Law Group. Samisha, a pleasure to have you on the program. We thank you so much for joining us this morning. I think what's really important to keep in mind here is that in the history of big tech, I would say in the last 20 years or so, Europe notably, and I would argue some of the other regulators around the world, were behind when it came to regulating things like social media, Instagram, acquisitions from Facebook, for example, getting a lot of scrutiny. And it feels like they're avoiding some of that repeat when it comes to AI. The question, though, is, do you think that it's a successful venture given the technology is so new?
I think that what the EU has done in the EU AI Act is a very thoughtful step forward. It is clear since last year, when we all saw what an incredible product that ChatGPT was and how much easier it can make things for us, that it also is something where we need to be clear about the safety concerns for vulnerable groups. We need to be clear that it will not contribute or exacerbate any kind of discrimination, efforts. And so what the EU AI Act has done, this risk-based approach, as well as trying to put some parameters around generative AI, is a real step forward. And we'll see over the course of the next year how quickly things move, whether the EU AI Act was the right parameters to put into place.
But that is a EU story, and Samisha, Europe is famous for being kind of a leader when it comes to regulating not just big tech, but corporate Europe for a while, almost to their detriment, almost discouraging in some ways some of the new technology that is then popping up in Asia or even the United States. What kind of precedent does it set for the rest of the world?
Well, I think that the EU is obviously in a very unique position because if you think about it, the EU is 27 different nation states. And so in order for the EU to have an integrated marketplace, which is what is supposed to be one of the benefits of all of these nation states coming together, they do have to have harmonized rules across the 27 countries. So in some ways, the regulation, whilst it can be very heavy, it is something that is necessary in order to have an integrated market. Now, in the US, there obviously is a little bit more of a focus on innovation and making sure that the innovation and the AI developments that have taken place so far, and in China as well, that those continue and that they don't lose any kind of space that they have in the market. But I think that the United States, the EU, the UK, the different countries in Asia as well, they all realize that AI technology is something new. It's incredible. We want to continue to develop it, but we need to understand and have some kind of safeguards for vulnerable populations. It's an election year coming up to ensure that the information that is provided to the public and is provided to investors is reliable information. So all of the countries, in addition to the EU region, have started to think about, okay, what is the common language, the common definitions, the common taxonomy that we can have to talk about AI and to talk about generative AI so that we can continue to promote the innovation and at the same time ensure market integrity and ensure consumer protection.
I mean, you named one of the kind of places in your list of the countries looking to tackle the AI story. The UK in particular, in I want to say the last year or so, has been very vocal about regulation around tech as well. The CMA, for example, very vocal about Microsoft's Activision deal amid many other tech acquisitions in the UK, setting a precedent, by the way, for the rest of the world. Samisha, are there then cracks between the EU set of governance when it comes to AI, the UK version of that, the US version of that? What are the differences here when it comes to that legislation?
There are significant differences, and as you pointed out earlier, the EU does have a much more prescriptive approach. The EU has taken categories of different AI systems, and they will classify them as minimal risk, high risk, unacceptable risk. Those unacceptable risks will be banned. So things like social credit scoring, how we have cognitive behavioral tools for vulnerable groups, for example, children, for example, activated toys, biometric identification, the kind of facial recognition tools. These the EU has set very clear parameters around it. What has happened in the US and what has happened in the UK is not quite as prescriptive. So in the US, we saw that President Biden had an executive order, very ambitious, covering a wide swath of areas from privacy concerns to healthcare to, again, consumer protection, also looking at how employees are treated. And what the U.S. has done so far, has said, we have legislation already in place. Let's encourage and tell the regulating agencies in these different areas to prioritize AI so that they can understand how AI-related risks can be managed within the legislation that we have in place so far. The UK issued a white paper. The UK is also, as you know very well, at the end of the year, had the first global AI safety summit. So the UK, while it doesn't have specific legislation on its books yet, is being very thoughtful about how to take that principled approach around safety, around privacy, around infrastructure that allows for innovation, but also manages any safety concerns that may arise, particularly for certain populations that have already been the subject of discrimination up until now.
Well, Samisha, talk to us a little bit about timeline here then. I mean, it feels like a very noble cause when you lay out some of the risks that these regulators around the world are seeing. But for a financial audience in particular, I think the timeline really matters here because this technology is growing so quickly. It's being adapted very, very quickly, even by the general public who, you know, people like me now know what ChatGPT is and can actively use it on a search engine. Can the regulation catch up? Can it match that speed?
You are absolutely making the right point. The timeline is very sensitive, and it's a very fast-moving product. The next iteration of ChatGPT will come out this year. We have no idea how it will change from the current version, but what is clear, if we're talking about the EU, for example, is that the EU AI Act will come into place in a graduated level. So in the first 6 months, it will ban those unacceptable risks that I mentioned earlier, the credit scoring, the biometric identification, et cetera. And then it will only be 12 months later that the EU AI Act will start to treat those more unacceptable risks, which may have some safety concerns, but that don't need to be outrightly banned. So we're talking about 2025 for that act. For the U.S., and the executive order, well, there's going to be an election year, so there won't be any more significant litigation than what we've already seen up until now. And as we've mentioned earlier, the UK is taking that principle-based approach, but doesn't have specific legislation. So whatever the Magnificent Seven and those tech companies have done for 2023, what they continue to do for 2024, and as they continue to have developments, we just have to hope that the regulations that we've put into place up until now are fluid enough to allow for at least those safety concerns to be addressed and managed.
Well, we're lucky we can count on you to keep us posted on that. Samisha Ferdinand, we have to leave it there, but we thank you so much for joining us this morning. A financial services lawyer at Ferdinand Law Group, bringing us the latest on that AI regulation story, which is sure to be the big theme for 2024. Now, coming up on the program, Ethiopia trades a stake in its biggest airline for access to the Red Sea. The move risks heightening regional tensions. We're going to bring you the story next. Stick with us. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Ethiopia has signed a deal with Somaliland, a breakaway region of Somalia, to gain access to the Red Sea in exchange for a stake in its flagship carrier, Ethiopian Airlines. But the deal by landlocked Ethiopia risks heightening tensions in a region that's already racked by conflict. Bloomberg's Ondiro Ogonga is all over the story. She joins us now from Kigali. Ondiro, what is the latest on this deal?
Well, as you rightfully said, Kriti, Ethiopia will get access to the sea from Somaliland through the Gulf of Aden, and this will enable them set up a military base and use it for commercial purposes for a period of 50 years. Further, 20-kilometer stretch will be leased to the Ethiopian Navy for a base, and it will also be used as one of their ports of entry, and Ethiopia is at liberty to develop infrastructure and a corridor. In exchange for value, then they get to give Somaliland a stake at Ethiopian Airlines and also recognize them as a sovereign state. If they do so, they'll be the first country to do so, and this goes to play in the international playbook of gathering support so that Somaliland can be able to source for funding and also seek for aid.
Talk to us a little bit about the Somali side about this. I mean, it does seem like a win-win on the surface, but clearly not everyone is happy. Somalia publicly denouncing the agreement. Can you walk us through the dynamic there?
They are not happy because they still consider Somaliland a part of their sovereign territory, and they're terming the agreement as an act of aggression against their sovereign and territorial integrity, and also it's a threat to their maritime resources. They say they're going to fight this through every legal channel available at their disposal, and part of the decisions that they're also making is we've seen they've pulled their envoy from Ethiopia, and this is not the first time that access to the sea is creating tension. Last year in October, Prime Minister Abiy Ahmed said failure to gain access will lead to conflict, and Eritrea, Djibouti, Somali came out to condemn this statement, saying their sovereign and territorial integrity is not up for debate. So this new agreement is highly likely to heighten political tension and further strain diplomatic ties in the Horn of Africa.
Bloomberg's Ndiro Ogonga in Kigali bringing us that crucial story from the continent of Africa. We thank you so much for your insight and reporting this morning. I want to bring to you some of the other news stories we're following from around the world. Back in the United States, Harvard President Claudine Gay is stepping down, ending a short tenure marred by allegations of plagiarism, as well as a campus controversy over anti-Semitism. In a statement, Gay says it's in Harvard's best interest for her to leave the job. Her exit is a dramatic about-face from her acclaimed start in July as the university's first black president. Speaking of presidents, Donald Trump has filed a lawsuit seeking to restore his name to Maine's presidential primary ballot. The state last week declared the former president ineligible for another term under the U.S. Constitution's 14th Amendment, which bars candidates who've engaged in insurrection. Now, Colorado Republicans have already asked the Supreme Court to reverse a similar decision in their state. And social media site X has started showing news headlines again alongside links shared to the service. The move reverses a change that owner Elon Musk said had come directly from him back in October. Critics have said removing the news headlines made it more difficult to determine what articles other users were sharing. And we go right back to the markets here. Speaking of one of the biggest players, let's talk about JP Morgan hitting a record high in share price yesterday in the U.S. session. This is really important as we talk about the read-through into perhaps some of the net interest income margins from a lot of the central bank decisions from around the world. Higher interest rates means higher profits for some of these banks, not to mention a lot of the volatility in the markets also helps the trading platforms and the trading volume, which again feeds into the market making that JP Morgan and some of its peers does as well. But the big question is now that we are going to see perhaps a little bit more calm going into next year on the assumption that the Fed has actually accomplished its goal on inflation and those rate cuts that are being priced in the market are actually going to come true. To what extent does this kind of momentum you're seeing by the biggest players like JP Morgan actually sustain? Well, that's just one take of it. Despite the rally, Wells Fargo analyst Mike Mayo has actually demoted JP Morgan as his top pick among big bank stocks for 2024. Instead, he's picking Citigroup. Here's why.
I think the bottom line is that Citigroup is becoming a much more simple and profitable firm whose earnings should double over the next 3 years. But this is make or break time for Jane Fraser. You said, is this due to Jane Fraser? Maybe. I think so. Yeah. But not definitely.
Wells Fargo's Mike Mayo speaking to Bloomberg's Romaine Bostic and Scarlett Fu about that turnaround story in Citigroup. Well, the analysts are noticing, and of course, Mike Mayo, a major player on Wall Street when it comes to that bank's coverage. And speaking of our bank's coverage, later today, do not miss our exclusive interview with Morgan Stanley's executive chairman, James Gorman. He, of course, is on his way out, transitioning to the new chief there. His final interview, an exclusive with our very own Sonali Basak, 3:30 p.m. London time, 10:30 a.m. if you're in New York, of course, 11:30 p.m. if you are joining us from Hong Kong. Now, coming up, we go from big banks to big pharma. Anti-obesity drugs could be worth $80 billion by 2030. We're going to take a deep dive into a market that's getting quite a bit of attention from investors. Stick with us. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's a market that's getting a lot of attention from investors. Bloomberg Intelligence is saying that anti-obesity drugs could be worth, get this, $80 billion by 2030. So far, the sector dominated by just two names, Novo Nordisk and Eli Lilly. For more on today's Bloomberg Deep Dive, Sam Fazeli joins me from Bloomberg Intelligence. Sam, so they're the stars of 2023. Will they be the stars of 2024?
Morning, Priti. So I want to just first up say that a lot of this work, 99.9% of it, was done by my colleague Michael Shaw. So a big shout out to him. Will the stocks perform the same next year? I think a lot of the expectation has already been explored by investors in these two companies. And given the day and a half of trading already this year, you can see that there might be a little bit of shifting going on in terms of people thinking, well, there's a lot of other pharma companies that we've forgotten about. Some of them may be active in this space, depending on how data pans out this year. So there could be a little bit of at least more interest in other pharma companies, not necessarily a major negative for Novo and Lilly, but more interest on the ones that underperformed in 23.
When it comes to the strategy that a lot of pharmaceutical and big pharmaceutical companies are using, is it then easier, is it incentivized almost to then go find these acquisition targets that specialize in anti-obesity, have already gone through the regulatory processes in various countries, as opposed to starting from scratch to build their own candidate?
Yeah, always. Pharma companies pretty much do that. I think you could assume that between 50 to 70% of a pharma company's pipeline is acquired. Not necessarily drugs that are on the market, but often products that are in development. And you saw a flurry of deals at that early stage of at the very end of this year. You saw AstraZeneca buy, not obesity, but generally a flurry of deals into phase 1, phase 2. So I would expect to see more of that, especially if in-house products fail. So let's say Pfizer, middle of the year, finds out that their efforts to try and convert their oral drug to a once-daily great drug doesn't pan out. They could become an acquirer of a biotech company that's developing obesity or metabolic disease drugs.
Talk to us then a little bit about whether or not you're talking about an $80 billion market cap, basically, until 2030. What gets in the way of that? Is that a realistic target?
Yeah, so in this particular area, I think the biggest issue is getting reimbursement, getting bodies such as the Medicare in the US to fund the use of these drugs.
Yeah.
And logically, they should. But we're in an election year. It's a huge burden on Medicare funding. It has to really be worked out quite seriously. And maybe more data supporting the broader health impacts of anti-obesity drugs, such as we've been seeing in heart disease, cancer, which we talked about earlier, 50% reduction in the risk of cancer with one of these drugs. Those kind of data will continue to build the case for getting these drugs to the people who need them. And then, of course, volume will go up, and then I'm assuming with that, price will keep coming down.
In terms of pricing, though, and this was something that was actually talked about, I think, in a Jefferies upgrade or Jefferies note this morning, talking about the likes of Novo Nordisk and AstraZeneca, among several others, are talking about that pricing power in the context of not just Medicare, but some of the political overhangs in the United States as well. What's the read through there? What do we pay attention to in 2024 in our last minute here? Yeah, in 2024, we do have the IRA, Inflation Reduction Act, coming out with the pricing that they've negotiated for the first 10 drugs that are going to be hit. And I think we're expecting that in the first quarter. I don't remember exactly the date that it's coming. That is going to be setting the tone for how pricing will evolve in the US. But pricing has always been a question with large pharma. It's never going to change. What the critical element here is, give the market innovative drugs that solve a major problem, and the market eventually follows. A really very, very interesting dynamic. Sam Fazeli from Bloomberg Intelligence walking us through what he's and his team are calling for is going to be an $80 billion market by 2030 when it comes to those anti-obesity drugs. You said it there, or he said it there as well. There has been so much momentum behind this sector as well. If you look at it from a more macro standpoint, some would argue this is a momentum, some sort of drive behind these stocks that is akin or similar to what you've seen in the AI story, where everyone kind of wants a piece of it, but there's only so many players. So that's going to be something to think about as we talk about allocation to some of these major thematic trends in 2023 and whether or not they spill over into 2024. Of course, we are only on the second trading day of the year, so it is early way to make that call. But again, $80 billion by 2030. That is the call from Bloomberg Intelligence on that sector. Up next, Bloomberg Brief, Danny Berger in London, Manus Cranny in New York, setting you up for the U.S. trading day. Stick with us. This is Bloomberg.
From a mining company, which frankly is dirty, it's big, now you want to reposition the company into green energy powerhouse. Are you a walking contradiction, or what did you learn along the way?
Well, in the early days, it was considered completely impossible for anyone. Doesn't matter if you're a huge company, like back then it was Anglo-American tried to break into the iron ore industry, and they spectacularly failed, even though that back then they were the largest mining company in the world. Now, for an upstart, a tiny little company with next to no cash at bank, no ground, no anything, for them to announce that they were going to break into the iron ore industry, the global seaborne iron industry, probably the most protected, viciously protected resources industry in the world, and then take them on head on, it was just considered impossible. It was just like a fairy tale. However, we stuck to the plan. We always tested each other by making sure that we were starting where we wanted to finish, which is as a major iron ore producer. And then we took all the steps back. We calculated what the steps would be, even though some of them seemed impossible. Now we have a strategy, and we've got to go flesh that strategy out and pursue it with single-minded focus.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
York City.
In London, in Sydney,
from Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's the worst start to the year in decades. Stocks extend their decline. Bonds steady after dropping in tandem. A January right in mega cap stocks for tech is the consensus, according to Bank of America. Hamas claims its senior leader was killed by Israel in an explosion in Beirut, Lebanon. The Israeli government has yet to confirm whether they are behind the attack. And markets count down the latest minutes from the Fed's December meeting, when Chair Powell's dovish pivot spurred a powerful stock and bond rally. A very good morning to you. We're data dependent. We're also information dependent. What will the FOMC say this evening in terms of the minutes? So we're looking at the job openings, the jolts. This has become ever more important throughout last year. It was the chart that just didn't really give. These are the job openings expected to steady at around 8.73, but it's the lowest since 2021. We have had a flamethrower across risk in the past 2 months. The bond market, as I said, you rallied by 100 basis points. You normally get that over the course of 1 year after the Fed cycle has hit a peak. Here we are this morning. Bond yields tick ever so slightly higher. The issue is, will the minutes add to the validation of the Powell pivot between December the 1st and December the 13th? That mighty pivot in 2 weeks. What will the minutes tell you about the validation of that or not? All you've had is a pause. The money, as soon as you had a risk-off event, the money flooded into the dollar. It had a cracking day, and so we're going to debate this row versus rates discussion in terms of the dollar. We're up an eighth of 1%. We put on nearly 0.7% yesterday. The oil market gives back a half of 1% this morning. Again, we are now in the show me mode, according to Macquarie. Yes, there's rising escalation between, we understand, the Lebanon drone attack yesterday and the deaths associated with that. But this is about supply, Danny. This is about show me the money in terms of the draws. Good morning.
Good morning. We'll be speaking with Bob McNally later about that in the program. Manus, I think you called it a carnival yesterday, the rally that we've seen in stocks and bonds. Well, it looks like the carnival, they've packed up, they've moved out of town. I don't know where they've went, because stocks declined yesterday, having the worst start to a year, the fourth worst start to a year on record. That decline continues today. S&P futures down 0.25%. NASDAQ does even worse, down 0.5%. It was really led by the mega caps yesterday, this decline, and it also moves into the European session. We're down just over 0.5%. But the two most important stocks yesterday that gave us a sense of direction, let me show you what they're doing in the pre-market, because one was Apple, the biggest decline in 4 months after Barclays downgraded it. That drop continues in the pre-market session, down 0.5%. JP Morgan, Manus, you and I are going to be talking about this later, but this thing hit a record yesterday, but that steam starts to run out this morning. It's down by about 0.1% this morning. But who really encapsulates this risk, Manus? It is Savita Subramanian over at Bank of America, who was out with a note yesterday, really prescient, given the style of the decline that we had yesterday. She wrote to clients, Manus, that crowding risk in the leaders of 2023 has been cited by many, including ourselves, as a key risk this year. She says that a mega cap route is consensus.
Yeah, I mean, that mega cap right is the consensus, but of course, the issue is there's 493 other stocks, and whether they pick up the slack from the right in the 7 is the debate. By the way, we've got a guest a little bit later on. The NASDAQ 100 has rebalanced. It's not as lopsided as you might think. There's only 2 stocks with just under 10% weighting. The 7th largest holding is just under 4%, Danny. So even the so-called Magnificent 7, if they stumble, it may not be as perilous as we all think. Good morning. Good to see you.
Yeah. Good to see you too, Manus. That's a really interesting stat, because we tend to talk about the hold the Mag 7 has over this equity market. Maybe it's not so big. Let's get more into this. Joining us now is Bloomberg's Sam Unstead. Sam, I mean, it was the mega cap stocks yesterday that really seemed to lead things off. But, I mean, how often does this indicate that the year is going to be bad if the start to the year looks like this?
Well, I mean, I have to say the start to the year, certainly yesterday, I mean, I was not expecting quite so much excitement. You know, that's...
yeah, we're all still, like, hungover from New Year's. We didn't need this.
You know, what you're seeing today in the market, where the moves are a little lighter, you know, things have actually deteriorated a little bit over the course of the European session, got a little bit more negative again. But today is much more what you would expect to see when you've got quite a lot of data coming over the course of the rest of the week. We've got the Fed minutes later, we've got payrolls on Friday. You would normally expect a bit more of a holding pattern, but yesterday that definitely wasn't the case.
Well, certainly never a great start when you see sort of blood on the screen and the bond market deciding to pause for breath. The equity market, you know, it was sort of like, whoop, there we go, 2% off at one juncture on the NASDAQ. But here's the debate, isn't it? It was such a ferocious rally, and the debate has always been, what level did the institutions participate in the ferocity of that rally in that part of December? Do you think it's a partial unwind or just a marking down of prices?
Yeah, I mean, I think that's almost exactly right, Manus. You know, I think when you look at across the moves yesterday, particularly the most negative moves you saw in markets, you were just mentioning the NASDAQ. You know, the NASDAQ 100 rose over 50% last year and had a big rally towards the end of the year. You had similar rallies in treasuries, you know. So yesterday it felt like, you know, I think when, you know, with the dust now settled, it feels like a little bit of a rebalancing of those bets, which, as you guys have kind of mentioned and alluded to, may well have got a little bit overheated in that over the course of December.
And how much of that is tied to what Barclays had to say about Apple in that downgrade yesterday morning?
Yeah, I think so. You know, I think with Apple, I mean, Apple over the course of the end of the year, you had, as I say, you had this huge rally across most tech stocks. Apple has started to miss out on that a little bit. You know, I mean, you got to remember, this is a company that's worth $3 trillion, right? So it's hugely highly valued. Barclays became a bear on the stock yesterday, and just highlighting some of the concerns about slowing sales. So maybe the attention on Apple as part of that kind of mega cap group is starting to diminish a little bit. But, you know, I mean, their fall yesterday wiped off $107 billion of market value. So it indicates that, yes, as you guys mentioned earlier, there's been a rebalancing in the NASDAQ. They're maybe not as important as they were previously, but it's still an enormous amount of money.
Heresy. Sam Unstead, heresy, I say to you. This is, how could you come on day 2 and say some of the shine has come on? Heresy. I'm going to put you in a room with Dan Ives over at Wedbush. He came on show last week. He was brave. He said, 4 trillion, and all you bears, you're far too bearish on the China story. So, you know, 4 trillion, put that in your pipe and smoke it. Now, well, give Dan a call. JP Morgan, what's going on? I mean, a victory lap for Jamie Dimon?
Yeah, I think so. I mean, so JP Morgan, one of the stocks that did very well last year, massively outperformed its rivals over the course of last year. And, you know, it only rose sort of I think it was just over 1% yesterday. But given the outlook for, you know, for rates over the course of the rest of the year, you may expect that will slow down. And actually, that does seem to be the consensus. You know, they had their rally last year. They added to it a little bit yesterday. But overall, the consensus seems to be that there's not too much more to go there, at least right now.
Sam, thank you very much. Sam Unstead there, and that is in jest, of course. Heretics. The best conversations are made out of a discourse. That's a bid and an offer, and somewhere in the middle you find the right price. Isn't that right, Danny?
I feel like you're trying to start a fight, Manus. I feel like you're I'm right. You're ready to put 2 rivals in a room and see what happens.
Do you know what? I'm stuck so far into the Apple ecosystem, it destroys the very piece, the last sort of piece of independence of
you
mind.
Me both.
Yeah, exactly. Okay.
But Manus, I got to ask you, what model of iPhone do you have? Because I'm still living in the world of 12, and everyone thinks I'm crazy.
Can I just say to you, this is the first time, actually, Danny, that I've managed to upgrade myself. I've got the full Monty, the 15 thing. It's not got the 3 cameras at the back. Do you know the other thing? I finally decided to buy this one rather than do it over, you know the way you do it over a plan. So I went in the drawer. There's like 3 old baby iPhones, maybe even a 12 in there, perchance. Maybe something older. And I tried to trade them in, and they said, this one's so old, mate, you want to take it back.
You know what I'm just hearing, Manus? I'm just hearing, like, I'm full America now. I'm buying the thing. No. I'm not going to, like, pay it in bits. I'm ready to spend money. Give it to me. I'm full hedonistic consumer. I love it. I love it.
I knew you'd pull up Paul Donovan's hedonistic consumer. I am partially part of that. I love consumerism. I love this country. There you go. Let's get to the trending stories on Bloomberg Terminal. There you go. That's enough evangelization about the United States of America. Speaking of which, the first IPO of 2024, it's in. BrightSpring Health Services, backed by KKR, filed for a U.S. IPO on the first business day of the new year, listing Wall Street's biggest banks in its plans. Danny.
I mean, signs are growing that China is trying to contain the damage from the harsh new gaming regulation that triggered an $80 billion rout in Tencent and its peers after a top official at the country's gaming regulator lost his job, that according to Reuters.
Abu Dhabi's largest listed company, led by the key members of the Emirates royal family, is setting up a new holding company with assets worth $27 billion across sectors ranging from financial services to mining.
It's coming up, we're going to talk about concerns over the Red Sea escalation. We'll speak to Bob McNally, president and founder of Rapidan Energy Group.
We'll also catch up with Jane Foley, setting the agenda on the FX stage at Rabobank. Risk off, and the dollar went bam, bam, bam.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's Bloomberg Brief. I'm Menace Cranny in New York. Danny Berger alongside me in London. The dollar is strong. The dollar is king. Just look at it. Resplendent yesterday, Danny, on the back of a risk-off move in the markets. Jane Foley is the head of FX strategy over at Rabobank. Let's bring that proposition to her. Jane, good to see you. The dollar was resplendent yesterday. Risk-off. We went straight to the dollar. Does that hold, or is there the risk that the Fed validates perhaps a move lower in the dollar? Good morning. There's a chart and a half for you to kick you off. Good morning, Jane Foley.
Good morning. Well, of course, there's a risk that the Fed validates it. But of course, if we look back to December, there was such a big movement on the back of the dovish take on the Fed in December that the market's just looking at risk reward and thinking, well, look, you know what? It moves so much in the dovish direction in February. Surely risk reward, there's more of a chance that there is a little bit of pushback today, and that's what yesterday's action was all about. But, really, if we look to see, yesterday morning how much the market was pricing in terms of Fed interest rate cuts, it was a huge amount. So I think it's only justified that we get some pushback. And to be honest, I think this bouncing around is going to, as the market tries to determine exactly when the Fed is going to start going, cutting, and when and how much it's going to go this year, I think this bouncing around is probably going to take us through, the first quarter.
Is it a bouncing around with the bias to the downside, or do you expect it to just bounce around pretty much flat until we can figure out, until we get to the end of the year and see just how many cuts there have been?
Well, you know, we in a way had this discussion last month as well, Danny. It's not just about the Fed cutting, it's about those other central banks too. You know, it's about the ECB, it's about the Bank of England, it's about the RBA, it's about them all. So this is all going to filter into the picture. It's not just about, oh, the Fed's going to cut sell the dollar.
Right.
You know, when we've actually maybe going to start pricing in other interest rate moves or change what we're pricing in for other interest rate moves from other central banks. Now, right now, I think that the market has priced in way too much in terms of the Fed. And, you know, we've got to look at the relative strength of the US economy. Yes, it's slowing. Yes, they'll cut this year, almost certainly. But the US economy is still so much firmer than, say, the Eurozone economy, than the UK economy. So I think to some degree that will limit, you know, how much the dollar can sell off and will sell off this year.
And that's maybe where the King Dollar moniker still relies, which then takes us to the natural question. All bond markets were reviewing their speed and size with which they presumably were going to cut. My question comes down to whether the ECB still outcuts the Fed, and therefore, can we look at the lower bandwidth that you put? You put down 104 to 112. Do you think there's no risk of a parity trade in Europe? Will the ECB outcut the Fed and therefore create this lower bandwidth?
You know, I have a lot of sympathy with the parity trade. Yes, it's not in our forecast table, but I do have sympathy with that view. And this is because of the competitive issues that Germany faces. You know, we don't have to look very hard. You can look through some of the IFO surveys, particularly the surveys of those large energy-consuming manufacturing industries in Germany. Look, for instance, at the car industry and how much competition it's got from Germany in terms of EVs. There are lots of issues with competitiveness. It boils down to the fact that energy prices, of course, won't be as low as they used to be, you know, before Russia invaded Ukraine. This is huge for Germany, and I do think that the Eurozone economy, the German economy, probably needs a relatively softer exchange rate in order to get through these competitiveness issues, which have really been highlighted by the relatively higher energy prices. So, you know, for me, over the next, 24 months, I think 104 to 112 is probably a better bet than a return towards, say, 120, because I don't think that the German economy could cope with that.
How much, though, beyond just interest rate differentials, how much will dollar as haven play a part in 2024? Because we've seen that in ebbs and flows. You had yesterday concern over escalation in the Red Sea, whether or not that contributed to the dollar strength. But is that still a clear force in this market, or is it just about rates at this point?
I think rates right now have got the upper hand. I mean, if we look at the oil price, then that tells us that the market isn't as concerned about the Middle East as perhaps some commentators thought we should be, or maybe we could be in 3 months' time. And certainly we can't take our eyes off the situation in the Middle East. And the news that we had yesterday suggested that there was a greater risk that the war spreads in that region. So we need to keep our eye on that. And if, God forbid, that war does escalate, then clearly we're going to have more of a safe haven bid. But if we park that to one side, and just look at those interest rate differentials, we do need to look at those growth differentials too. And I think as we move into 2025, what we're probably going to have is still a weaker Eurozone economy. And I think that's going to be something which is perhaps going to potentially, weigh on the euro. And that's aside from the outlook from the dollar. That's a different story, perhaps.
So I think when we were last together, we were debating stagnation nation in the United Kingdom, and I think that debate will continue. But I was drawn to Marcus Ashworth's opinion piece this morning, very much going head-to-head with Amundi. Amundi had this sort of really dreadful call for the pound. We expect the pound to fall apart, according to Amundi. In other words, it's going to be such a profound slowdown in the UK. But it's based on the assumption that the Bank of England will murder the economy, so to speak. But no central bank is going to let that happen. Do you think the pound will fall apart relative to the euro?
No, I actually don't. if we look back in terms of, euro sterling, perhaps to the spring of last year, then most of the time it's been quite range bound. Now, towards the end of last year into the autumn, we saw sterling underperforming a bit, and then towards the end of the year, sterling began to fight back against the euro. Now here, I think there was so much bad news. I think really since 2016, there's been so much bearish commentary with respect to sterling. I think there's so much bad news in the price. Sterling has never recovered where it was before that Brexit referendum in 2016. And I think right now, with so much bad news coming out of Germany, I think actually sterling can moderately outperform the euro. So, by the end of this year, I think sterling will be just slightly better against the euro.
Jane, really quickly before we let you go, are the yen bulls going to be disappointed again this year?
I think that the yen will perform better, but I think the yen bulls, the real winners, will be disappointed. I don't think it will do as well as many are hoping.
Okay. Kind of worst of both worlds, actually. Jane, thank you so much for joining us. Really appreciate your time. This is Jane Foley of Rabobank. Manis, in the meantime, what are your bond markets doing?
Ooh, time for reflection. Pause, reflect, maybe even pivot. There you go. You're just seeing the yields back up a little bit right the way around the world. What you've got here, Danny, is US Treasuries just up by 4 basis points. We'll get the JOLTS data later and the ISM. Germany is flat and phlegmatic. Roll it over. Have a look at the UK because, as Jane says, it could be the hidden economy that doesn't have as much brutal downside as Europe. Bond yields this morning up 2 ticks. That's state of play on bonds.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
I think the bottom line is that Citigroup is becoming a much more simple and profitable firm whose earnings should double over the next 3 years. But this is make or break time for Jane Fraser. You said, is this due to Jane Fraser? Maybe. I think so.
Yeah.
But not definitely.
Maybe, I think so. Is it due to Jane Fraser? Either way, Manus, he is a bull. That's Wells Fargo's Mike Mayo speaking to Bloomberg after publishing a call on Citi where basically what he's done is for his top banking stock for 2024, it used to be JP Morgan, which has had an amazing run. We'll talk about that in a bit. He's now put Citi there, basically saying that it's underappreciated. He talks about investors repeatedly telling us, don't talk to me about Citigroup. And part of that negativity sentiment, which I love, is the reason that it could double over the next 3 years.
You've been in some of those investor meetings and don't talk to me about Citi. You know, 119 bucks, 131%. You're starting harsh. I'm starting a war over Apple, and you've been in one of the investor meetings for Citi. You got the inside track. I mean, $119, that's 131% higher than where we are at the moment. And if you look at the performance, have a look at the KBW index just for a reference. And at the top of the stack, it's Capital One, then JPM, Wells Fargo, and Citi comes in. You know, you can see where the gap potentially is to close. You know, it's everything to win for Jane Fraser. Citi only rallied 17% last year relative to that 42% in Capital One. But, you know, the beast of banking is there. It is JP Morgan.
Yeah, I mean, let's be honest. 2023 was a tough year for pretty much every single bank that didn't have J, P, and M in its first initials. Even to the point where Jamie Dimon, he probably was cautious about it hitting a new record yesterday as much as anyone. It wasn't that long ago in earnings. He talked about the bank over-earning. In other words, the earnings will normalize. So can the records continue? I mean, even he is skeptical on that front.
Well, that depends probably on the exuberance or let's say are not of the U.S. consumer as well. Goldman, of course, topped JP Morgan on the advisory side as they came into the end of the year. So you're going to get this battle. Also, if interest rates peak out, and where are we on delinquencies? Those will be, I think, the three definers for JP Morgan and the mantle of the head of banking.
Yeah. Though, of course, Goldman is paying up more to keep all those bankers. So, you know, maybe some of that will end up coming out on the wash.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Stocks extend their decline after the NASDAQ 100 kicks off the year with its biggest loss since October. Bonds steadily fall in tandem with equities. Hamas claims its senior leader was killed by Israel in an explosion in Beirut, Lebanon. The Israeli government has yet to confirm whether they were behind the attack. And markets await the latest minutes from the Fed's December meeting when Chair Powell's dovish pivot spurred a powerful stock and bond rally. Well, can those minutes yet again get a rally going? Because at the moment, the market is craving it. We're declining again today after yesterday we saw the fourth worst start to a year from this equity market. S&P futures fall about 0.25%. NASDAQ underperforms 0.4%, while Europe follows the trend. But it really was the mega cap stocks that disappointed yesterday. It was the Barclays downgrade of Apple, not to mention some unwinding of the pivot bets. And at the same time, you had JP Morgan hitting an all-time record, though that's declining this morning. Pre-market Apple down 0.5%. Manis, JP Morgan is down 0.1%.
And Wedbush Securities has a $4 trillion market capitalization on Apple. Validate me, not you to me, but that's what the bond market is screeching for. We've done 100 basis points of a drop in the space of 2 months. Normally, SocGen say you only get 100 basis points drop in the over a year when a central bank has peaked out and finished hiking rates, but you've already done that in 2 months. So really, you want to sort of calm yourself down on making a major market call on day one of trading in the bond market. It was just simply a little bit of a reprieve before the minutes. Let's see how much validation that gives to the Powell pivot, as you say, later today. You've got Jolson, you've got ISM manufacturing coming in, and that's ahead of a jobs report at the end of the week. The dollar is bid. We've just had Jane Foley from Rabobank saying, you know, stop writing off the dollar. The dollar will remain king and integral because other central banks will cut more aggressively on a relative basis to the Yankee, and that will help it maintain its position. We went straight to FOMO yesterday, and bam, 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 we went straight into a dollar bid. Oil is offered by 0.5% There's just simply no war premium in this price. This market is now obsessed by the supply side. We've got Bob McNally standing in the wings to talk to us about that market. But this market, according to Macquarie, is in show me mode. Show me the cuts, show me the draw, show me the deficit. Danny.
Man, so I think those comments from Jane are so fascinating because it's really easy to get wrapped up in just what the Fed is doing, what the minutes will say today, in which they are, of course, really important. Everyone should stay tuned into Bloomberg TV to find out what they say. But she makes the argument, look at what's happening with Europe. Look at what's happening with Germany. Growth is so weak that that's also going to play an important part in why the dollar can hold on.
Yeah, and she's got more sympathy for the parity call. She didn't call parity, but she said, I have more sympathy for the parity call. I mean, her bandwidth is 104 to 112 rather than trading up to 120. And it is to the heart of Europe and the German, the dissipation of the engine of Europe, which is Germany. Danny.
Yeah, and she also said, look, don't discount the dollar as a haven trade. If things escalate, that could be the next leg higher. She said it's not necessarily playing out today, but that brings us to the latest in what's happening in the conflict in the Middle East. A senior Hamas leader, Manis, was killed by Israel in an explosion in Beirut, that according to Palestinian militant group, raising fresh concerns of a regional escalation of the war in Gaza. Joining us now is our Middle East breaking news editor, Patrick Sykes. So, Patrick, here we have Hamas saying, or rather Hezbollah and Hamas saying that Israel is responsible for the killing, but Israel at this point hasn't said that they're behind it yet, have they?
That's right, and I think we shouldn't hold our breath for that admission, to be honest. What we do have in terms of response is from Iran, from Hamas. Late yesterday and through today, for example, Iran's saying that this incident will encourage what they call resistance to Israel, and that they're holding the US, well, specifically Israel and its allies, its supporters, so responsible for the incident. So I think anyone on the side of Israel will be also checking their risk as well to see where that potential retaliation could come from.
Patrick, good morning. And therein lies the issue. How will this escalate? Where will this escalate? What scale will it escalate? Will Hezbollah take the fight directly into Israel? And what are the consequences of that? What do you think it means in terms of the ratcheting process and evolution?
Yeah, I mean, Danny mentioned regional escalation. I think this is what regional escalation looks like. If you wind back just a month or two ago, we were focused on the border between Israel and Lebanon. Hezbollah and Israeli forces clashing there, fairly tit for tat, all within the rules of engagement, as they call them, where they kind of respond in kind to each other. This is far beyond that. This is a strike, allegedly, in the heart of the Lebanese capital, in the heartland of Hezbollah, the southern suburbs of Beirut. And I think, yeah, they obviously have a clear incentive to try and respond, to avoid looking weak, while also factoring in that calculation of not overdoing it and not provoking a war like they had to fight in 2006.
Patrick, thank you. Yeah, and this is one of the first direct strikes into the heart of the capital since 2006. Patrick, thank you very much. Patrick Sykes, our Middle East breaking news editor on the very latest on the Israel-Hamas war in Lebanon. Now, let's discuss the implications in the commodity markets. Bob McNally is the founder of Rapid Energy. Bob, every so often we get together and we talk about the lack of war premium, the lack of concern in this oil market. You say the most recent assassination of a top Hamas official underscores your above consensus 30% odds of disruption to the oil and LNG markets. But the markets are not reflecting that by a long chalk, are they?
They certainly are. And good morning and Happy New Year, Manus. They certainly aren't. But it's understandable to some degree why they're not. In my view, the market has sort of tuned out, broadly speaking, Middle East disruption risk since November 3rd, when Hezbollah leader Nasrallah gave a big televised speech and said, we are not opening up a second front with Israel. I think the market understands that the path to a real disruption and a real risk premium leads to Iran, and that's through Hezbollah in southern Lebanon. And when Hezbollah said, we don't want a big war, and Israel said, we're focused on Gaza, the market, until the Red Sea disruption started, has pretty much tuned it out. And that's probably going to remain the case until we see material escalation, as your colleague just said, going beyond the border skirmishes that have been happening so far on the northern border of Israel, and we escalate to something bigger.
But Bob, does the fact that Israel is willing to go seek out Hamas officials in a different country, not in Gaza, represent Israel willing to escalate?
No question at all. This was the first attack since 2006 in Beirut. You know, there's a rule. Hezbollah doesn't attack Jerusalem or Tel Aviv. Israel doesn't attack Beirut. Well, yesterday Israel attacked Beirut. And the Nasrallah, the Hezbollah leader, warned a few weeks ago. He said, Israel better not start assassinating Hamas leaders, our guests here in Lebanon. And Israel just did. But here's the bigger problem coming at the market, Danny. After October 7th and those massacres, Israel will not tolerate terrorists on its immediate border. Israel is saying Hezbollah must move back from the northern border, one way or the other. Diplomacy, if we can, military force, if not. U.S. doesn't want to see a major war there, trying to walk Israel back. That's the next shoe to drop, is will Israel insist that Hezbollah clear out of the northern border to protect those 85,000 residents who won't go back until it's safe.
But where does this leave us, Bob? Because the market is failing to or reluctant to price in the kind of scenario that you've just outlined. Is the market more preoccupied with the supply the non-OPEC supply? Is that why we have such a strong contango in this market? It is supply ultimately that is the nemesis of a serious rebound in this market.
That's right, man. Since late September, the oil market has been in a supply-driven, mainly funk, headed straight down with occasional pullbacks when something flares up in the Middle East, but it's just headed down. We didn't get those big inventory draws late last year that everyone thought we were going to have in the summer. Even Indian demand, a rock star on the demand side on oil, decelerated. China not doing great. And OPEC Plus so far not effectively signaling coherence and an ability to put a floor in. So that remains the main driver. We're headed down until we see those inventory draws or geopolitical risk materializes.
Does that mean then the risk of a supply shock, Bob, is much higher than it traditionally is?
I think so. As I said, Rapidan is telling clients it's at least 30%, because while Tehran doesn't want war, President Biden doesn't want war, no one is willing to de-escalate. Everybody is escalating here. Over the holidays, I mean, Iran sent a long-range drone to hit a tanker off of India, and then the U.S. accused it of doing so. And as we saw, the U.S. is shooting back now at the Houthis. This is not de-escalating, so I think the market is too complacent. I think there needs to be at least $12 of geopolitical risk. I mean, a 30% chance of a Hormuz type of event is a kind of a $12, I think, premium, and I think we have pennies in the market right now.
So that would take us to $87 on Brent. Do you think it'll be a slow grind to that level?
No, I think we're probably going to see events sort of jolt us higher. And again, I would look mainly to Lebanon and Israel and Hezbollah, because that's coming next after and as Gaza winds down. Also, any more Iranian adventurism. I mean, if they start launching munitions from their own country, as they did last week, and attack oil tankers and vessels closer to Hormuz and so forth, and we focus on that, it'll go higher. Because remember, the Red Sea is a shortcut. It's no fun having to take 2 extra weeks and going around it, but it can be avoided. Hormuz is a bottleneck. That is a heart attack. And I think that's going to come on the table as Iran continues to escalate here.
Is that like a near certain possibility of escalation, Bob? What would you put it at the odds of something like that happening?
Well, I'll be clear. So we think there's 30% chance of a no-kidding, real material disruption in oil and LNG flows from the region. 30%. I would say the market is closer to 3%. So we think events will cause the perceived risk to go higher because everybody is in escalation mode here. Nobody is de-escalating. The reason we're at 30 is because most major capitals, Tehran, United States, and Washington, they don't want to see a major war. But you don't always get what you want. And we're in escalation mode. And Israel has more business to finish in the region. So I think as events unfold, we're likely to see more escalation, stepped up attacks, and as a result, the market's going to sort of be dragged back to this bullish Middle East risk.
Yeah, well, we'll see what happens when that awakening of this market occurs. Bob, really wonderful to have you this morning. Bob McNally, founder of Rapidan Energy. And a quick look at the commodity market. We are holding on to those losses again. Bob says that there should be another $12 of war premium priced in. We are certainly not there. Manus, these prices have been declining for 5 straight days. Over those 5 days, oil is down about 7%.
It is indeed, and you just had a call from Bob there. $12 of war premium is yet to be priced into a barrel of Brent. That would take you to nearly $88 if events come to pass, as Bob just said. Beautiful shot of London, Danny. Good morning from New York.
emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
We had some pretty tough talk.
bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
So healthcare finished its first day of trading this year, Manus. As the biggest gainer, tech stocks, as we've been talking about all day, they were down. A little bit of an about face. Maybe the thing that is really going to fuel this industry is that $80 billion market from obesity drugs introduced by Novo Nordisk and Eli Lilly. Let's bring in our expert on this, Bloomberg Intelligence's Sam Fazeli. Sam, somewhat ironically, I actually had a bit of a debate about this while stuffing my face with Christmas pudding about how big this obesity market was, because this is the world we live in now. How big is this market? How addressable is the market for obesity drugs?
Well, good morning and hello, Manus. Nice to see you. It's been a while. So the market, as I said earlier, all you have to do is walk in the streets and you see the people, that you can count them, you can do the stats yourself. This is not cancer or neurological disease that you can't see it. It's in our face. So from the demand side, from the number of people who would benefit from this drug, these drugs, you can see what the opportunity is. On the other hand, countries need to afford it, because if you take that number, multiply by the price that you get to much higher than 80 billion. We're at about 10 to 11% in that estimate. For the US and 6 or 7% for Europe. That's scratching the surface, right? And so imagine if actually everybody who could benefit from the drug was allowed to take it. I mean, the numbers are silly, right? Even 80 billion, I think some people would say, sounds a bit crazy. So they need to get cheaper, and that obviously will then drive volume. So the size of the market will probably be about the same anyway. So that's what I think we need to see, that pricing evolve.
So, Sam, good to see you. I haven't seen you in about 5 years. That just said, you join us more. Danny and I, we're going to see a lot more of you, I think. That comes down to pricing. So here's the thing. I have friends that come from the Middle East to here, and they buy their Ozempic here because it's 50% cheaper. Go from here to the Middle East. It's 50% cheaper in the Middle East than it is here. This comes down to pricing and insurance. And unless those two things commoditize, then there's a limit on the size of the market that you're suggesting.
Yeah, so the pricing, that leverage or arbitrage that your friends are doing, I think does go on to a degree in some countries, but it's not that easy to do, because that's obviously a pretty big journey to take to do this. The pricing needs to continue to evolve, and it will do. As the volume goes up, by payers, currently insurance companies, will keep putting pressure on. And I think what's going to happen next is, of course, we need the Medicare in the US to come in and put pressure on the prices, but we don't expect approval by Medicare to come before 2026. And then in 28, 29, it's possible that Wegovy gets hit by the impact of the IRA. And the IRA might drive that price down, which will, of course, only impact Medicare. So those things need to go hand in hand. But there's no question that this drug business is going to get more competitive and prices are going to come down.
Well, to that point on the competitiveness, Manus and I caught up with the Novo Nordisk CFO in their last earnings, and we had asked him, look, are you worried not even about the Eli Lillys, but all these new entrants who are trying to come in the market? He basically said no, that, you know, it's a really big pie. Is that fair, or should the Novo Nordisk, the leader in this space, be worried about competition?
I think they don't need to worry about competition for at least a few years. The market, the stock market might behave differently. If Pfizer comes out with some magical data in the middle of the year, say with their oral pill, or Amgen comes out, they've got 2 drugs going, or some other competitor comes out with, the stocks will react. The point is, by the time they come to market, there will be a well-established business for Mounjaro, for Zepbound from Eli Lilly, and Wegovy from Novo Nordisk. And the market is so massive that all players can benefit. And it will come down to that pricing. And they'll all be in the same boat. And the evidence behind these current front runners will be much stronger than the ones with the competitors coming on. So it's difficult to displace. That never happens in pharma. But you don't completely lose your market because somebody else comes in.
Right. So we've become a bit myopic, haven't we? We're a bit obsessive about weight loss drugs. It's what catches the headlines, and that's what we do here. But what are the other bigger trends, perhaps, that we should keep an eye on in pharma?
I mean, Manus, it's so hard to pick different trends. There's so much exciting development from science that's been translated to drugs and therapies for people. One particular one that comes to mind is at the back end of last year, we got approval for these gene editing drugs, which were only a concept about 10 years ago. And so I think if you look to 2024, the kind of excitement that I'm looking for is, first, the approval of a second Alzheimer drug, potentially in the US for Eli Lilly. And then, of course, we'll be watching how that performs. It seems to have better efficacy. And then, of course, you've got a lot going on in oncology. And there we're looking for some new developments in immunotherapy. And the M&A. M&A is the big thing that pharma, you saw a flurry of deals at really right up to the end of the year. And I think we're going to see more of that.
Yeah, and hop on your Bloomberg. I'm just looking here. You're writing about lung cancer sales and the potential evolution. $10 billion across lung cancer sales is possible if the drugs do better. All the research is there. Dip into your Bloomberg terminal, Sam's name, and you'll get everything you need on the pharma industry, and the team is there. Coming up with Danny and myself, a little bit more market-moving events today. We're going to have some data, we're going to have some jolts, we're going to have some ISM, and let's see how Apple does. We'll run you through the slate in just a moment. From New York, we're down an 1% on the S&P 500. Good morning.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
All right, let's get you set up for your trading day on this Wednesday and get you a look at what's ahead. We're going to have some economic data coming out of the U.S., JOLTS job openings and ISM manufacturing data. Those come out at 10 a.m. Then at 2 p.m., the Fed will be releasing minutes from its December policy meeting after a dovish pivot by Chair Powell on that decision. Then after that, we're going to have some Fed speak. Richmond Fed President Tom Barkin will be speaking on the 2024 outlook at 8:30 a.m. In the meantime, Manus, is pretty quiet in the pre-market session. We still have that tilt lower, but also impacting things are some of the EV numbers we had out yesterday.
Yeah, I mean, if you look at Tesla, fourth quarter deliveries came in at 484,000. The estimate was for 483,000. I'm just using the rounding there. The issue is about it's the competition, really, isn't it? In terms of Rivian, in terms of BYD, and obviously BYD beating Tesla. And the question now comes down to how can they hold on? There's Rivian. They dropped as their year-end EV deliveries. They fell short of the estimates, Danny, didn't they?
Yeah, they did. Look, the real issue here is the delivery shortfall. They're having a lot of issues when it comes to the supply chain and just general slowing growth in the EV market. But we talked about this yesterday. The fact that the Chinese competitors, the BYDs of the world, are able to catch up, that's bad news for Tesla, which before had a stronghold on this market.
Yeah, and if you look at the Tesla numbers, it was the Model Y, the sport utility vehicle, and the Model 3 that accounted for 95% of their deliveries. But as I was walking over to Saks yesterday, because 60% off, Danny, consumerism's killing me. They had two beautiful electric vehicles just on the side. They had the Lucid electric
Did you get me
vehicles.
one?
I popped in. I said, "Where's the Amex?" I said, "Oh no."
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
We've got an economy that has probably hit a soft patch, but I don't think it's going off a cliff. So I think that gives some room for a broadening out of the market.
I'm bullish on equities. I think we're going to have a bullish broadening.
You want to be selective, even within what appears to be a nicely broadening rally.
I think the prospects for growth here, while not boomy, look reasonably good.
I don't think that you can have the kind of growth that we've had given the kind of economic backdrop that we're looking at.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P pulling back again, this time by 0.2% on the S&P. Last year's big winners, TK, some of yesterday's big losers, turning 2023 upside down to start the new year.
Let's go technical, and we're nowhere near support right now. We pulled back yesterday. I noticed, John, as you did, and Lisa, I think, led on this, frankly. There's a fair amount of hysterics out there about a first day OMG, the worst since time began. It was of biblical proportions. You look at any chart right now. I've got two standard deviations, SPX up. We're nowhere near a center tendency of support. I'm going to call it 4,600. We're not there.
Headline this morning: Max Kettner, HSBC, with this one: Bramo, cut stocks, cut credit, go to cash. That's a big change from Max to start a new year.
Yeah, who has been basically talking about Goldilocks and go heavily into risk all of last year, even when other people were bearish. Why? And this is, to me, the most interesting part. Is it because he actually sees earnings going down or there not being this disinflationary trend? No. What's the fly in the ointment? He said sentiment and positioning. That's the entirety of it, and that seems to be the anti-Goldilocks.
Yeah, and Tony Dwyer at Canaccord, I mentioned this yesterday, using the word giddy. Maybe it's not as eloquent as Max Kettner, but it's the same idea. There's an effervescence.
To Lisa's point, reverse Goldilocks is what Max is looking for now. This line jumped off the page to me. We continue to believe that from a multi-asset perspective, the biggest risk is not from a sudden deterioration, but another repricing in rates. TK, that final point, a big point.
Yeah, the repricing in rates is there, and it's percolating this morning. Antoine Gara over at the FT, killing it on an analysis of private equity and private credit. In their struggle with the new rate regime, yeah, we got a breathtaking fourth quarter. You know, things got better. But what if we reverse? No one's really framed that out. That's almost like a Jim. You talked to Bianco yesterday, right?
Bianco looked at the same thing, yeah.
What did Jim Bianco say
What's
about
the pain
this
trade of
yesterday?
2024? What will it be? And this is guessing, but ultimately he thinks it could be another repricing in rates, which is what you hear from Max Kettner this morning. Bramo, next stop, Fed minutes. Did they, didn't they discuss cutting interest rates sometime soon?
I mean, first of all, does it matter? Because frankly, how much credibility does this have? What I find more interesting is the market reaction. How much are people poised to sell bonds if there is any pushback whatsoever of possibly cutting rates this year? I will just say that right now, even Neil Dutta, who has been talking about this immaculate disinflation, came out yesterday and said, 6 cuts seems like too many. Everyone's pushing back. So this is sort of the sober January as everyone comes back, reassesses, okay, our adults in the room, let's get get back to work. This seems a little over the skis.
A sober January on Wall Street.
Something like that.
That's what this is. Okay. Yields pushing higher again this morning. Here's the price action for you. Yields up by 2 or 3 basis points on a 2-year, on a 10-year by 3 or 4 to 396.68. Equity futures lower, negative by 0.2%. I talked about turning 2023 upside down to start 2024. Lisa, you saw that in foreign exchange as well.
Yeah, you saw the biggest rally in the dollar going back to March. Again, this sort of retracing of some of the trades from last year, especially because people were basically saying that the ECB wouldn't really have to cut rates, and people are now saying, yeah, right. All right, here's what we're watching today. 8:30 a.m., Richmond Fed President Tom Barkin is speaking to the Raleigh Chamber of Commerce. Does he push back against rate cutting? Does he lead into some of the softness that we're seeing? 10 a.m., we get ISM manufacturing and JOLTS job openings. ISM manufacturing, I know that, John, you've been really in on this, and the fact that we've seen a steady contractionary state in manufacturing since October of 2022, more than a year, really speaks to the disinflation in goods, not services, that has driven some of the recent sentiment. At 2 p.m., it is the FOMC meeting minutes. Did they, didn't they, does it matter? What it matters is how much does the market reprice to any assumption that the Fed doesn't want the market to price in 6 cuts, right? I mean, that to me is how much do people have a trigger finger to sell bonds in response to any pushback.
What's this one doing at 2 p.m. Eastern Time?
He's sleeping.
I'm reading Cameron Dawson's research note at 2 p.m. this afternoon.
Sure you are. Cameron Dawson joins us now, Chief Investment Officer at New Edge Wealth. Cameron, good morning and Happy New Year.
Good morning, Happy New Year.
Are you sitting on the fence? Because I'm reading this first line in your work. It says, we could have a scenario where both bulls and bears are right this year. Which one is it?
Well, I think that we have to be nimble, because I believe that there's going to be a scenario where you could very easily see people get drawn even further into this market. We think positioning is overweight, but not quite as extreme as it was in times like 2021 or 2018. So you could see some pain get pulled in. But the other reality is that you could see a rationalization of the fact that sentiment is very extended and that valuations are extended. So it's how you react to market rallies or market corrections, I think, is how you will win in 2024.
We mentioned HSBC, so let's talk about the work coming from Max Kettner this morning. Here's this line: biggest risk, another repricing in rates. Do you agree with that?
100%. That's the pain trade. The pain trade is that everybody thinks that inflation is fully vanquished and then gets surprised if things like oil prices move higher, wages end up being stickier than expected, rates move higher, and then all of those stocks that re-rated in the last 2 months up 30, 40% because now they're not worried about their balance sheets anymore. Balance sheet risk becomes an issue again, and you get a reversion of a lot of the names that were lower quality that happened to lead at the end of last year.
The modeled out earnings are 9%, 10%, dare I say double-digit 11% earnings growth for this year. Is that in the price now, or is that going to develop out in the first half of next year?
It is in the price now, and I think that we always have to think about the path of 24 will be pricing in what actually happens in 2025. So if a recession looks more likely in 2025, that's when you'll start to see those earnings estimates get cut into the out years. The thing that's the biggest challenge for us for earnings estimates in 24 is the expectation that top-line growth will re-accelerate in a year where nominal growth, because of inflation, is expected to decelerate. Can you see that happen at the same time, where we get less inflation, less pricing power, and yet we get a big acceleration in top line?
So away from the romance of Apple and Microsoft, if you look at staples and discretionary and all, you've got a model out there, what? You go back from a 6% wonderment of growth back to 4% revenue growth?
Yeah, very likely. And there are idiosyncratic pockets where you're going to see improvement. You know, Healthcare had its earnings down almost 20% last year. That will flip positive this year just because of easy comps. So that's where we're trying to look outside of just the macro drivers, staples being a great example of one that can't get away from this inflationary dynamic, and look instead to the more idiosyncratic opportunities.
Are banks idiosyncratic opportunities? I ask with JP Morgan at new record highs.
Yeah, I mean, you've seen such a huge re-rating. Of course, there's pockets of banks where there is still inexpensive areas. You know, banks do have the tailwind of a less inverted curve, hopefully a reopening of capital markets, but then we have to consider things like BTFP, does it get re-extended, Basel III endgame, all of these things that could be big drivers of bank earnings, or at least appetite for bank risk as we go through 2024.
It sounds like you're not buying the rotation story.
I am buying the rotation story. Yeah, I think that we have to have an open mind that even great companies with great balance sheets, with near monopolies, could still underperform simply because positioning is so crowded and because valuations are so elevated.
That's the smartest insight I've heard in the last 48 hours. Are we going to have rotation or not? That's a really, really undersaid question.
I think that was really some of the angst behind the sell-off that we've seen that was really led by big tech. We were talking about this yesterday with Apple, and I guess that, how much does that have legs versus what we saw last year, which was a head fake, and everyone came in saying, all right, this is the year to sell tech, and by the end of the year, everyone was saying, NVIDIA, Magnificent Seven, it's going to change the world, kumbaya, it's going to save the United States, et cetera, et cetera.
And what a different setup, because at the very end of 2022, you had record outflows from tech ETFs. You look at the course of 2023, you had $40 billion of inflows into technology compared to $20 billion of outflows out of things like energy and financials and healthcare. So really, this could just be about positioning and pain trades, and the fact that you already re-rated tech, because now it's already just one turn away from its 2021 peak valuation, so you're hitting a ceiling.
Let's put a couple of stories together. You said maybe the biggest pain trade. The risk here is higher rates, the repricing of rates again. Lisa brought up banks. How would the banks respond to that, given what we saw last year?
Yeah, it would raise balance sheet risk again. It probably puts into sharp focus again issues with commercial real estate, because we've all kind of breathed this collective sigh of relief that higher for longer is dead. If it's not dead and the path of the cost of capital, instead of the last 40 years of being down, is actually marching slightly higher and in a choppy path, could mean that we have to reprice some of the risk in some of these balance sheets.
Is it just JP Morgan, then everyone else? When we talk about the banks, is that what we're talking about? JP Morgan, then everybody else?
We actually just are looking very deeply at some of the regional banks. Some of the regional banks are underpriced, we think. If we look at the balance sheets, they're not as extended or as issued as some parts of regional banks, that some don't have as much commercial real estate exposure, have great presence in their local areas. So they're trading at very discounted valuations. If we're going down in value, that's one of the areas we're actually looking.
Yeah, but somebody had over, the last 5, 6, 7 days that JP Morgan's capturing 1 out of 5 profit dollars in American banking. If that isn't the 3rd or 4th or 5th national bank of the United States, I don't know what is.
There is nothing else. It's JP Morgan versus everyone else. That's been a story the last year.
I'll defer to our guest on this, but yeah, they're capturing some 20% of profits according to the source. I'm sorry, I don't have a source in front of me to cite. I think it's the Bramo newsletter. You know that newsletters.
It's a must read.
It's a must read.
Cameron, thank you. Got to leave it there. It's good to catch up. It's good to see you. Happy New Year. Cameron Dawson there of New Edge Wealth. Pushing forward, Lisa mentioned Fed minutes and some data coming out a little bit later. Need to talk about Friday as well. Let's have a little chat, a conversation about payrolls. Here are the estimates so far for payrolls at the moment. Non-farm payrolls, median estimate in our survey. As always, this can change going into the number, but a survey so far gives you a median estimate of 170, on unemployment 3.8%. Here's the view from Goldman, 190 on payrolls, at least a 3.7% on unemployment. So if you're looking for a slowdown in the labour market, in the broader economy, doesn't scream slow down, does it, Bramo? Doesn't scream it.
Well, this is exactly the reason why repricing in rates seems to be the biggest potential risk for a lot of people, because does this type of labour market really represent a consistently disinflationary environment when you've got wage inflation running at about 4% year over year? That's also what we're looking at. This, to me, the underpinnings of just how much average hourly or weeks earnings are really coming down, whether we're actually seeing the unemployment rate rise. We saw it actually reissued lower than it had been before. All of these things really paint to the fear that we could potentially get either sticky inflation or even a tick back up in how much prices are increasing.
I looked at a 4-week moving average of weekly claims. I don't use it as much as I use the Friday data, but tomorrow and Thursday, today's Wednesday, right? Tomorrow and Thursday, look at the claims to see when do we finally get the lift up off of about 211,000. 5 years ago, John, if you said 211,000, that's a gift from God.
Look, claims, that was the guide for 2023, I think. And Lisa mentioned the manufacturing guy, Sam, and right to point out that it's been sub 50 since late 2022. So it's been in contraction territory. That tells you something about manufacturing. Of course, it's worth still having a look at, but ultimately it didn't tell you what was happening elsewhere in the US economy. Yeah. And Lisa, if you just focused on claims, in and around 200K, that just spoke to the resilience and sometimes the strength of the U.S. economy through last year.
And this is a reason why Nathan Sheets pointed to this divergence, that a lot of the disinflation has been driven by goods disinflation. He put out a note yesterday basically saying that right now, given where service inflation is running, it's around 4%, and it's way above where the Fed would need it to be. This is the reason why people are worried about that stickiness.
John, I go to the ECI year over year. This is wages and benefits combined. It's just one of many statistics. And the answer is normal's 2.5%, 3%. We went up to 5%. We've only rolled over to just about 4%. We got a ways to go to bring wage inflation down.
Are Fed speakers taking a day off, Tom? You noticed that? I'm just looking on the calendar.
Yeah, well, they're probably waiting for the 5-year auction.
No, Tom Barkin. He's speaking. He's speaking twice today.
Okay.
So he's really, he's
I've got
representing.
Logan and Bostic.
Well, you know, they're starting the year
just
slow.
Just a quiet start.
Maybe.
Okay.
We might add some in there.
Do they have like non-voter day where on one day all the non-voters speak?
And people don't listen?
Tom Barkin.
Well, they don't listen anyways.
Right. Tom Barkin's a voter. Just want to say, voting member. Yes.
New round of voting members.
Yes.
We can talk
Goolsby,
about.
I think, is off. He's been silenced.
Okay.
Goolsby's been
I doubt
muzzled.
it. I doubt it. Coming up in the next hour, Tracy McMillan of the Wells Fargo Investment Institute to weigh in on all of this. To kick off your trading day, equity futures pulling back just a touch, adding to the losses of yesterday. We're negative 0.2% on the S&P. From New York this morning, good morning.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
The president has said we are ready to act in self-defense if needed. I'm certainly not going to get into specifics of our military operations, but the president is always and has always been committed to our service member and protecting our service member abroad, and that's what the president's going to be committed to.
That was White House Press Secretary Jean-Pierre speaking on ABC yesterday as the Biden administration looks to defend against Houthi attacks in the Red Sea. The latest this morning, TK, according to Hamas, a senior leader killed by Israel in an explosion in Beirut, raising fresh concerns, of course, about a regional conflict. taking place?
Not the time for a civics lesson on the distinction between Hezbollah and Hamas, but the answer is this is a triangulation Lisa talked about on December 7th, whatever the date was, here in Israel. And that is, this is triangulation between Gaza, the West Bank, and now up to the northern border in Lebanon. It's a long ways away from Gaza.
If we're worried about escalation, we're not seeing a big move in the commodity market. Let's get up the screen and go through the board together. Starting with Brent and WTI. WTI actually down on the day now. Negative on the session by 0.2%. Lisa, $70.25. Brent crude basically unchanged, $75.90.
And we felt this tension yesterday, where initially crude popped in response to Iran sending a warship over to the Red Sea. And then the risk aversion took hold. So here's the question. Does that reverse at some point, or really is the risk aversion and incredible supply from the U.S. going to dominate in an otherwise somnolent commodity market? It's really surprising.
To your point, Bramo, yesterday crude was up close to 3% at one point. Tom, ended the day down by almost 2%.
Yeah, I thought the under 70, now $70.27 on West Texas Intermediate, but the 69 print in the blur of yesterday, you know, the enthusiasm about a tough stock market and what bonds did. To see oil pull back, I think, is notable. I mean, it's all there is to it. Joining us now on our many politics, Terry Haynes. He's founder of Pangea Policy. Terry, I don't mean to make light of this because these are tragic fronts, but you say to the cliche, we are all quiet on multiple fronts. Is America ready for multiple fronts of defense and offense in military? Taiwan, Ukraine, and what we see in the Eastern Mediterranean?
I think there are two answers to that, and both of them start with no. One is the level of actual preparedness to be able to be what Franklin Roosevelt used to call the arsenal of democracy. I think the answer to that is no. I get a lot of backup on that, positive backup on that in markets. The other sense is, are we emotionally ready for that? I don't think that's the case either. I don't think either in the public or in markets, frankly, there's an understanding of just exactly what needs to happen and how. If we were actually working on this to the degree that we need to in 3 regional conflicts and potentially more, we'd probably be invoking the Defense Production Act, and the president has not invoked that for defense. He's invoked it for a lot of other things, but not for defense.
The World Bank keeps score on this. I got 33% as the defense to GDP in war-driven Ukraine. Here it's 3.5%. Granted, it's higher than many others, but is the basic idea in Washington we're spending enough on our multiple military efforts?
The basic idea in Washington is that we ought to be spending as much as we are, and that seems circular because it is. What we've got is a situation where the back and forth over budgeting and what we're actually going to spend. In defense, what that comes around to is, are we going to maintain current levels of spending, or are we not? Generally speaking, we're going to maintain current levels. But if you think responding to a threat means spending more money on it, as Washington usually does on other areas, I don't see that in defense.
At this point, given everything that's going on internationally, how much are people paying attention to January 15th and the Iowa Republican caucus?
Oh, I think they're paying a great deal of attention to it. You know, you've got a sort of a tumbling series of events that are going to happen in both internationally and domestically to kind of shake people out of their torpor here post-holiday. The domestic event, I think, certainly will be the Iowa caucuses, because then we'll figure out whether Trump supporters are more energized or more fatigued by everything that's been going on. Internationally, I think we kick off with the Taiwanese elections, which stand to create additional market jitters, frankly, no matter what happens. If the independence candidate wins, then China will bare its teeth even more. But if the more assimilation based candidates win, then people are going to be confused about what comes next. So either way, it's going to be a problem.
You said that people have been a bit complacent about some of the political risks. This always seems to be the charge, that markets need to wake up to the political risk, and then politics happen and markets go the opposite direction of what everyone thinks, and then can realize that they absolutely should have ignored it. Why is this time different, that people should be paying attention, and how should they be paying attention from a market perspective?
My point's real simple, which is that There are two things that related to this that underpin markets. One is geopolitical risk. The other one is U.S. domestic risk. Markets have been so used to for so many years, 50 years, 60 years or more, for the idea that there's going to be relatively stable U.S. politics and there's going to be relatively stable geopolitics, that they've forgotten or never experienced a time when neither or both of those was true. And my concern is that we may be approaching that domestically. I think we're certainly approaching that geopolitically with all the potential problems that exist.
Terry, stagger on from Iowa to New Hampshire to March 5th. I believe we're going to have a Super Tuesday this year, maybe not. When we get out to October, the conventions before that, et cetera. Does any of this talk matter, or do we vote domestic policies?
Right now, I think we vote more than anything else. We vote domestic policies. The concern about people hitting the policies hitting them in their pocketbooks, and Bloomberg has done some excellent work on this as to why why we should take people's inflation concerns seriously. But beyond that, suffusing everything else as a concern in the public that we're not responding well enough to foreign crises, and we're a bit a step behind. And the question of whether the Biden administration is going to be up to it, firstly, and secondly, whether the alternative vote, whether it be for a Republican or a third-party candidate, feels like an improvement, I think is also going to be important.
Hey, Terry, appreciate the update. Happy New Year, sir. It's good to hear from you. Terry Haynes there of Pangea Policy. Just to push forward through the rest of the programme this morning, Dan Ives of Wedbush is going to join us in about 20 minutes' time on a big move lower yesterday in Apple. On a move higher, JP Morgan, all-time highs at a close yesterday. Lisa, we'll catch up with Jared Cassidy of RBC Capital Markets at about 7:45 Eastern Time.
I'm so looking forward to this conversation, not only because JP Morgan was at record highs, but Mike Mayo of Wells Fargo yesterday came on Bloomberg Television and was talking up Citigroup, saying he expects the shares to double and triple over the next 3 years, profits to double in that time period. At this point, even Cameron Dawson talking about she's looking at regionals and sort of buy the dip in banks after a pretty brutal year for everyone.
I just wonder where the roll-up is. I mean, I understand the major banks can't buy anything. They can only buy something when it's in crisis. See Silicon Valley in Republican, all the First Republic and all that. But to Cameron's good point, let's go. I've been saying let's go for what? 5, 6. Last time the Red Sox won. I mean, it's a long. Last time the Tots won. That's been a long time.
They've been winning.
Well, they've been winning, but they've been winning like Liverpool winning.
Well, you say let's go, but stocks have been going. So we've got the regional banks up in November by almost 14%. Regional banks up in December by almost 16+%.
When are they going to merge? When are we going to get scale? Scale is that's the word.
There also is the Apollo in the room, right? The Aries in the room. This is sort of the question around private credit, private equity, all of these behemoths that have all of these money pools and tons of investors and locked up capital that are eating the lunch of the big banks. How do they compete if they have to pay people big bucks to come in and really lead a similar effort?
2 Fridays away. Earnings from JP Morgan, put that in the diary, January 12th, February 2nd for Apple, early February. So that's a slate of things, 2 names for you to put in the diary over the next couple of weeks. That's what's coming up on the calendar. Coming up next on this program, Constant Hunter of Macro Policy Perspectives on this economy. Looking ahead to Fed Minutes later this afternoon. From New York, this is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Live from New York, here's the price action for you. On the S&P, on the NASDAQ, equity futures looking like this. We're negative 0.3% on the S&P. On the NASDAQ 100, down by 0.4. The small caps pulling back by almost 0.75%. The NASDAQ with the biggest one-day loss since October, which incidentally was the last time we had a weekly loss in this equity market on the S&P 500. So the NASDAQ turning things upside down from the end of 2023. Big gains turning to some marginal losses for the equity market. And just throwing some fuel on the fire, Max Kettner this morning of HSBC. Some interesting calls to start the year. Yesterday, a downgrade on Apple from equal weight to underweight over at Barclays. This morning, HSBC, Lisa, cutting stocks, cutting credit, going to cash.
Because of sentiment, because of positioning, talking about reverse Goldilocks at a time where everyone had already priced in all the good news. Now the good news might overwhelm some of the dampening effect on yields, and that seems to be what people are focused on this morning.
The risk of a repricing in rates. So let's talk about the bond market. Chop it up, 2-year, 10-year, 30-year. Looks like this. On a 2-year right now, higher by 3 basis points to 434.92. Tom, on a 10-year, 397.06 this morning. Yields higher by 4 basis points.
Into the economic data that we have, the 10-year real yield, 1.75%. And I went back and looked at just some moving average studies, and there's a level there at 1.60, a level below that at 1.20. And too many guests have suggested we tendency back to 1.60. I wonder how desperate part of global financial Wall Street is to get the real rate back down. I think that's a real desirable goal right
So
now.
that's the bond market, Tom. So you remember November, December, yields lower. More recently, yields higher. Then November, December, equities rallying. The last 24 hours, equities lower. Through last year, first down day for the US dollar since 2020. Guess what happened yesterday? Lisa, just the whole of last year in reverse. But very small moves, of course. The US dollar showing some strength again this morning. The euro against the dollar, 109.20.
It was the biggest move for the dollar, the biggest strengthening move, I believe, going back to March. So we really saw a significant shift as people thought maybe the U.S. economy doing better than Europe actually matters for something at a time where people discounted the ECB actually following through with rate cuts because they believed them for some reason.
I think that was a yawn from TK.
I know, I saw that.
Foreign exchange.
That was a
That's
really
my
big
question
one.
is, have you caught up with your sleep yet? I mean, I got to catch up with my sleep
from New Year?
from the vacation.
To walk through that.
You know, I'm just trying to get January 3.
Vacation makes you tired.
I'm thinking like January 5, January 6, we may find stability.
The dollar index showing a bit of strength, positive by 0.3%. Let's get you some top stories. Under surveillance this morning, Harvard's Claudine Gay stepping down as president following controversy over anti-Semitism on campus and accusations of plagiarism. Gay writing in a statement, "It is in the best interest of Harvard for me to resign so that our community can navigate this moment of extraordinary challenge." Lisa, with a focus on the institution rather than an individual.
And a lot of people saying that this came as a result of plagiarism accusations, less some of the testimony to Congress around how the school was going to respond to anti-Semitism. The bigger question here is, what is free speech on college campuses? How are people going to foster a true platform where people on all sides can really air their discussions without pressure on one side or another to be silenced? And this, to me, is the discussion that we're not hearing loud enough from some of these colleges, how they're going to move forward on that level.
If somebody said to me, what are the 5 most important conversations of 2023? There's Mark Rowan of Apollo coming off the dinner of the UJA in New York, which he heads, which he spirits, talking about his University of Pennsylvania. My guess is, John, this doesn't end with a Harvard. The billionaires out there, the philanthropists of these schools, they're looking at this school by school.
Yeah, but we shouldn't just make this about rich guys taking on leaders at universities. This is about something much, much bigger than that.
Sure.
Lisa, you mentioned what this is all about, free speech. And what we've seen on campus over the last 10 years, in the words of Mark Rowan of Apollo, preferred speech, not free speech. And to your point, they've got to figure this out and figure it out fast.
And frankly, that's what interests me more, because if it's just people pulling their checkbooks away from the colleges, that's not free speech either, right? So at this point, how do you have a conversation about what is truly a way to enable a diversity of thought without penalizing people, shadow banning,
So what's
doxing?
the formula at your University of Chicago? The acclaim nationwide is Chicago has nailed this discussion. Why are they different than the other schools?
Well, there's a history of not necessarily having a partisan take, but also there is no university stance on any political issue. They do not come out and say, we stand with this, we stand with that. And so they didn't have to come out and take a stance. Everybody speaks for themselves, and people can have independent opinions.
And more on that story a little bit later. Let's get you the next story. New concerns of a wider conflict after a senior Hamas leader was killed in Lebanon's capital of Beirut. 6 in total are dead after a drone strike in a city suburb yesterday. This marks the most senior Hamas leader believed to be killed by Israel, Elisa, since the attacks on October 7th.
And people talking about the potential for escalation, although there hasn't necessarily been any kind of response. Look, this is exactly what Israel said they were going to do. They were going to go find the different Hamas leaders in the different nations and take them out. So here's the question. If nobody from Hezbollah was killed, if it was 3 people who were killed and they were largely connected to Hamas, is Lebanon going to respond, given what happened with the Lebanese war? I mean, these are some of the reasons why people maybe aren't paying as much attention to this as a possible escalation.
This has been the big question, I think, Tom, over the last 2 months, the prospect of this spilling over to other places, to Lebanon, to Iran, to elsewhere.
Yes, we mentioned it here 20 minutes ago, but yes, the geography of Israel goes from the south up to the east and then up to the north in Lebanon.
We promised you updates on this story, so here is your update on it. Investigators confirming a Japan Airlines flight was cleared to land before crashing into a Coast Guard plane at Tokyo's Haneda Airport yesterday. All passengers aboard the Airbus airliner were able to escape as the jet burst into flames. 5 crew members on the Coast Guard plane were killed. Elisa, the accident still under investigation.
All I can say is when you read the stories of survival of the people who are on that plane and what the crew members on the plane, on the passenger plane did to get them out, they deserve a medal, honestly.
You know the video that we all ignore that plays before the start of a flight? Yeah, I think you should probably pay attention to that.
You know, all right.
No joke
to actually read those sort of exit strategies?
Seriously, given the near misses we've had in this country, in America, what took place in Japan in the last 24 hours, isn't that the ultimate fear, Tom, here in America, based on what we've heard from several reports across airports in this country?
You're more eloquent than I am. I alluded to it yesterday. I thought I was pretty clumsy about it, but you nail it. It is an American thing. Frankly, I think it's a European thing as well. These are huge, intractable budgetary issues. This is about spending money.
That investigation continues, Tom, but I think elsewhere that's a tragic wake-up call for a lot of people elsewhere too.
On the American economy right now, Constance Hunter joins us working with Julia Coronado, Macro Policy Perspective. She is a senior advisor. Constance, I love your note where you fold in our economics within our finance. How linked right now is the economics of Coronado and Hunter to what we see in the stock market?
Well, and they're linked because obviously, as you were talking about earlier, they're linked because of what's going on in bond prices. They're linked because we saw a pullback in wealth, of course, in the third quarter. Expectations of an increase in the fourth quarter. This impacts how people feel about the economy. It impacts how they're going to spend, and of course, that is the big question. So, what happens with that intersection of weaker economy, lower inflation and how the Fed responds.
I've had the privilege of talking to Alan Greenspan about this since the idea of, measured, the concept of an incremental Fed, which I'm going to editorialize, Alan Greenspan invented. How urgent is it for them to do 1 or 2 of 5 or 6 rate cuts now to assist Wall Street, because rates at the Fed are sky high?
Well, I don't think their goal is to assist Wall Street. I think their goal is to assist Main Street. And so if they do those cuts, they're going to be to assist Main Street. And I think that it would be beneficial to Main Street if they do them in March. And it is our view
Why
that
not January?
Because I don't think the data quite gets them there yet. I don't think it quite gets them there. They need to see a 6-month annualized rate of 2% on their key metrics, whether that's core PCE, PCE, right? They need to see that in order to move and maintain their credibility.
The characterization of the balance of risk has clearly shifted in the last 12 months, in line with the data. It makes perfect sense. What do you make of, one, the recent communication around rate cuts, and 2, how would you expect that to show up in the minutes later this afternoon?
Well, look, what we're not going to see in the minutes is we're not going to see talk about rate cuts, right? That's going to be not part of the minutes. They were part of the forecast. They're clearly were, as they have said, we're focused on other things. The minutes are going to show that they were focused on other things. And I actually think that the minutes, while everybody's going to watch them for little signs of did they slip in a sort of a little sly communication, what we need to focus on is what's happening with the data. And what we need to understand from the Fed is it only inflation? Or are they taking into account a slightly softer economy coming off of that blockbuster Q3, slowing down in Q4, and what we anticipate is going to be a little bit slower growth in Q1?
Didn't we get a reaction function shift, though, from the Fed? I mean, this is what I'm looking for, that basically, if they see inflation moving down, even if it's well above their target, even if there still are concerns about service sector inflation, even if housing prices are ticking back up at pretty hefty paces, that they're going to cut rates because they're more concerned about killing the employment market than anything else.
Well, let's dissect housing for a minute, because that's a really important factor. So what you see on new home sales and what you see on existing home sales, right, that's not what's in the CPI, right? What we have is that owner's equivalent rent, and we have rental prices. And market rental prices are falling rather dramatically, and that is going to feed in to the owner's equivalent rent. Secondly, supply is a huge factor in the prices that we're seeing, and higher rates limit supply. So you can make an argument, and a credible argument, that if you had slightly lower rates, you would actually promote more supply, and you'd be less likely to have this price pressure in housing.
So the reason why I'm struggling with this is because I'm trying to understand what the reaction function then is for the Fed. Are they going to look at potential situations that come down the pike, or are they going to look at the fact that prices are rising, there's still a sticky service sector inflation, they haven't killed the beast yet, and that's the biggest fear that a lot of people have?
Yeah, it's a legitimate fear, but if we look at the run rate and we look at what we're forecasting, by March, you're going to see a 6-month annualized rate at 2%. And then the question is, have they hit their target by then? And you look at someone like Messer, who, a year and a half ago was saying, we don't have to get to 2% to cut rates. We just need to be making credible progress. And you have a lot of Fed presidents that have said something similar, right? And so the question is, what constitutes credibility, right? And do we need to see sticky services? Do we need to see services prices falling? Or are we okay with disinflation in goods pulling down the whole index? And you're right, we don't know. We don't have absolute clarity on their reaction function.
So new year, new voting members. Do you pay much attention to the shifting complexion of the FOMC, the committee? Does it matter?
Yeah, it does. It does matter. I mean, it absolutely matters in terms of absolute votes. And it matters in terms of the tone of the conversation in the room. But look, for the most part, there's been a fair amount of consensus. And then there's that whole school of thought, you don't want groupthink. Do you want every vote to be a consensus vote when it makes sense for some dissent? And we all say we want diversity of thought, we want diversity of ideas, we don't want groupthink. So some dissension, actually, I think, is a healthy sign at the FOMC.
Begs the question, where is that official dissent? Why haven't we seen it?
Well, look, I think that the raise and then hold has not been controversial. I think that's been a very prudent thing to do. I think I think that we haven't seen dissent on that, because it just, a reasonable person would think that makes a lot of sense as a course of action.
I'm waiting for that hand to go up, Tom, in the next few meetings. Someone just to say it might be time. to cut interest
I think
rates.
the way the United Kingdom does it is dramatically better. There's all consensus, this fake consensus that the Fed is just blowing. Maybe recently they've been more in consensus, I'll give them that.
Well,
but just this dissent-free, we are the world, forget it.
I don't know that this is the we are the world. It's just that to Constance's point, it was more obvious. When inflation was running really hot, they had to kill it, and they raised rates really rapidly. The quickest pace going back to the 1980s. Then they stopped because things were cooling down, and you saw inflation coming down. Now is when you would see dissent. Now is when you'll start to see people coming out and raising their hand and saying, on the margins, this is what I'm going to emphasize versus that.
Next few meetings, maybe. Constance, it was great to see you.
Great to see you,
Happy
too.
New Year. Welcome to the program, as always. Constant Hunter there of Macro Policy Perspective. Those Fed minutes coming out, TK, a little bit later on this afternoon. Will they, won't they discuss interest rate cuts in them? Constance says no, probably not, Tom.
Some, several, a few. McKee actually keeps track of those strange words within the minutes. A few said. Some said.
McKee reads them.
Several said.
Unlike you, so he can
I can
translate
say,
all of that for us.
I'm embarrassed to say this. I never read.
You've never read the
entirety,
minutes?
In entirety.
Okay, that's different.
I've never read them.
Different.
What does that mean? I mean, doesn't everybody skim over certain paragraphs?
That's different. That doesn't count.
Honest.
Well,
that doesn't count.
You know, they line up everyone who's there before like 400 people are in the room at the Eccles building. You know.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Last year, tech was fabulous in its performance because it had been so brutalized in 2022 when the bears sold all of tech. The long duration they sold because they were worried about refinancings, but they sold the good stuff that was highly profitable. Look for babies that get thrown out with the bathwater in downdrafts to add to positions that you're building. And in essence, what you want to avoid is just blindly buying dips. You want to be selective.
That was John Stelfus of Oppenheimer Asset Management on the tech sector. One stock to watch this morning, Apple. The tech giant falling 3.6% at the close, its biggest one-day drop since September. The drop following Barclays downgrading Apple to underweight. It was the quote we talked about in the last 24 hours a fair bit. The continued period of weak results coupled with multiple expansion. Tom, in the opinion of Barclays, that is not sustainable.
Let's get right to it. That was clearly the story today. It was just, do you agree it was just one of the reasons why we went down yesterday?
Yeah,
but,
one.
You know, it was
not the
tangible.
reason, but one of.
It was tangible. There we are. Let's get right to it. This is so important right now. Dan Ives joins us. He is a bull on any number of technology companies. We wait for him to come out on controlled data here with a buy recommendation at some point. That's a little bit of history there. Dan Ives with Wedbush. Dan, what's a channel check? What exactly is a channel check? I just don't see it.
Yeah, I mean, look, for us, in terms of our Asia supply chain checks, really trying to focus on what demand looks like in terms of the suppliers for iPhones. There have been no cuts from an iPhone perspective as of date, and I think that's bullish. And ultimately, that shows demand through holiday season has actually been on par to actually better than expected. And to me, that's what I focus on rather than the haters continue.
Okay, but Dana, you've been gracious about this, and they've been gracious about your 2023 ginormous success. But when you do a channel check, are you counting iPhones? Are you over in China guessing the manufacturing line? Are you in the store on Madison Avenue looking at how many people from Lisa's family are buying Apple loot? What's a channel check?
Yeah, all of the above, Tom. I mean, we're in Apple stores around the country, around the world. We're also talking to suppliers, basically trying to triangulate to what we think units is going to look like for the quarter and for the year. And that's how we've done it from the beginning, I mean, over the last decade. So, and it's one, you're always going to have differing opinions. You talk about the Barclays downgrade. We continue to stick with our checks that has navigated us, a lot more right than wrong. I think when you look at iPhone 50, it's easy to take shots, relative to maybe some of the fears out there, especially fire in a crowded theater, first day of the trading, year. It's a Groundhog Day. We saw it last year as well. It's underestimated. 250 million is the install base upgrade cycle that's due in that window, hasn't upgraded in 4 years.
Dan, let's get into it. You mentioned Barclays, Tom mentioned it too, I mentioned it. So let's get to that line. The continued period of weak results coupled with multiple expansion, not sustainable. In that is a statement of fact, and then there's an opinion at the end. The statement of fact is iPhone sales. They haven't been great for the last 12 months. That's a fact, yet it's been coupled with multiple expansion. Also a fact. The opinion piece is they're saying it's not sustainable. Are you suggesting that it is?
Yeah, so what I'm suggesting is that the next 3 to 4 quarters, you're going to have iPhone growth. You have growth coming out of China, despite the fears and obviously a lot of the bear noise. And I think the most important thing is services. I mean, I think services is going to be teenager type of growth. That's key to the multiple expansion story. And then we go into later this year, there's just going to be more monetization from an AI, as we talked about. That's going to be the next layer. I think it all results in this is going to be viewed as more of a golden buying opportunity rather than the start to, hit the elevator exit.
How much, Dan, is your bullish call predicated on this idea of rate cuts, the idea of rates coming down as much as people think?
Yeah, look, that's probably 5-10% from a multiple perspective. I mean, as we saw 22, the disaster, 23 in terms of now popcorn moment, in terms of Fed going to cut in 24. Look, it speaks to our overall bull tech thesis, right? That the soft landing, Pillsbury Doughboy's soft landing, you're starting to see now more and more focus on tech. I do think now, as Ferro's talked about, multiple expansion in 23, I think the numbers show it in 24. That's the difference. 24 is where the numbers come through in tech. 23 was more the multiple expansion.
Well, you mentioned China and how China demand is going to pick back up, but I wonder if it's going to be for iPhones, and I know we've been talking about this for a long time, but yesterday this caught my attention. The Chinese automaker, BYD, surpassed Tesla in terms of deliveries for the first time. You're seeing that really start to be a main theme. People said that that was never going to happen. People say that it's never going to happen, that Chinese consumers are going to throw out their iPhones. What makes you so confident that we're not going to see the same thing happen in the iPhone cycle that we're seeing right now in the electric vehicle one?
Yeah, great question. And look, when you focus on Tesla, I mean, that's essentially a 2-horse race between Tesla and BYD. Tesla actually beat numbers, and China was strong for them. But I think it does speak to, look, domestically, BYD, they're a beast. I mean, they've done a phenomenal job, but Tesla is also going to be a winner there in China. When you look at what's happening within the China market from an iPhone perspective, it speaks to just the massive install base that they've built in China. You have 100 million iPhones in China. Right now, a window of an upgrade opportunity. And the irony is, despite geopolitical, the last 18 months, Apple's gained 300 bips of market share. Because the average high-end, I'd say middle-income Chinese consumer, they want an iPhone despite government basically trying to push Huawei.
Dan, I'm so pleased that Lisa brought up the EV comparison, because I think that industry right now has the potential to be the industry story of 2024. Dan, beyond BYD, beyond Tesla, how much of a reality check are we getting for the industry, for the likes of GM and Ford?
I think a big reality check. That's why you've seen Farley, I think Mary, they pulled back, in terms of a bit from the EV strategy in Detroit. And the problem here is, do consumers want EV or they just want a Tesla? And I think that's really the issue that's really starting to play out. And at this point, Tesla's doubling down on EVs. But no doubt, there's been, I think, much more moderate demand that we're seeing across the board. And, I think as that plays out, you're going to see others peel back while others go more aggressively, like the likes of the Tesla.
I wonder what you think the end game actually is. If you speak to the leadership at GM, of Ford, they've been generous with their time. We've had this conversation with them. They talk about a change in execution, maybe not a change in strategy. Would you expect to see a change in strategy this year, and what would that look like?
I think slight change in strategy where maybe they pull back on some of their long-term numbers in terms of EV, when they expect to go fully EV, as it goes 2034, 2035. Look, the UAW also put their back against the wall. It's a different cost structure. And they're trying right now it's a tight balancing act that they're trying to get to in Detroit. And I think also it's tough going up against the likes of Tesla and some of these other EVs. That's been a big part of the problem that they're focused on, especially now with the UAW increasing the cost structure.
Well said, Dan. Good to hear from you. Happy New Year, sir. Dan Ice of Wedbush, constructive on the likes of Apple, constructive on the likes of Tesla as well over the last few years. Let's finish on the EVs, Bramo. The distinction, I think the difference between the ambitions of the administration and, for that matter, governments around the world to achieve these lofty goals in EVs, and reconciling that with the support for unions that we've seen in this country over the last 12 months at automakers, at Ford, at GM, whether something's got to give in 2024.
And you're seeing a give in Ford and GM ratcheting back their expectations for electric vehicle sales because people just aren't buying them. And it goes to Dan Ives' good questions. Do people want electric vehicles or do they want a Tesla? Are people waiting to see whether you're going to have some sort of build out of the charging station? I will just add, you are seeing a massive slowdown, though, in car purchases in general. So this is sort of
where are we on that number? 15 million, 18 million, 12 million? It's really slowed down, right?
Yeah, Cox Automotive expects that U.S. auto sales will be up less than 2% this year. And you're seeing that pretty steadily in the numbers that came out yesterday and that are coming out today and tomorrow.
Stephen Trent, Citigroup, moments ago, reaffirming a buy on United Airlines. How do you do that with the way fares have come down? I don't get it, but he says they've got a trans-Pacific leg up, and he's got a phrase. John, I've never seen this phrase before. United Airlines is refleeting.
Refleeting.
I have no idea. Refleeting, I think, is Cathay Pacific was out earlier off of Bloomberg Asia. I guess they're refleeting too. I think that's by new. It's like deplaning.
These stocks had a really strong finish to the year. November, December for the airlines on the S&P 500. Coming up next on this program, Tracy McMillan of the Wells Fargo Investment Institute. She'll join us shortly. In your equity market on the S&P 500, we're negative here by 0.3% on the S&P. Yields pushing higher once again by 4 or 5 basis points, 397.44. The dollar weaker through 2023, starting 2024 with a bit of strength against the euro. 109.20 on the euro against the dollar.
Emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything.
If you're losing more than half the electricity you put into electrolysis, is it a viable alternative to some of those fossil fuels?
Yeah. I mean, have you heard of oil? Have you heard of gas? I mean, you convert oil out of the ground, refine it, turn it to diesel, whatever you like, which is going to cook the planet. You've already lost 60 to 70%. I mean, yes, there is a conversion loss from not losing an electron going from wind and solar straight into the grid. That's why it's the lowest cost energy in the world. But there's a conversion loss. Oh my God, a conversion loss. The oil and gas sector, you know, green hydrogen's got a conversion loss. It's like putting lipstick on a pig from the oil and gas sector. You know, they have had a conversion loss since 1810, right? And remember, relative dollars, their dollar per barrel was $1,600. Let's not forget that. That's how they got going. Subsidies, $1,600. Wow, it's better than burning wood. Now the same companies stand in the road of green hydrogen and say, oh my God, it's not as efficient as us. We've only had a 200-year head start. Hundreds of trillions of subsidies, which we've swallowed from taxpayers. They should get none, and they want to do it in 8 or 9 years. You know, who would you back? I back us.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We've got an economy that has probably hit a soft patch, but I don't think it's going off a cliff. So I think that gives some room for a broadening out of the market.
I'm bullish on equities. I think we're going to have a bullish broadening.
You want to be selective, even within what appears to be a nicely broadening rally.
I think the prospects for growth here, while not boomy, look reasonably good.
I don't think that you can have the kind of growth that we've had given the kind of economic backdrop that we're looking at.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on day 2 of trading in 2024, pulling back by 0.3% on the S&P 500. Typically, when you get days like that, TK screams, go to cash. Max Kenner of HSBC doing just that this morning. TK, cut stocks, cut credit, go to cash is the call from HSBC
and
he gets respect. He gets respect. Max was well out front with a bullish call last year. I think we were in London, where he was pretty lonely on some optimism for 2023. So I do know what Max is saying this morning. What I'd say, John, is everybody's back. There's some liquidity back in the market. And I need to see it settle out. And what is that around? It's around the key economic data we see in 2 days.
More data coming up later this week, including payrolls on Friday and then earnings next week. And the call from Max Kender this morning, Lisa, it's not based on the risk of a sudden deterioration in earnings or activity. It's based on the risk of another repricing